Right. Okay. Good evening. Right. Uh, I hope so you can hear me.
Yes, sir, we can hear you.
Right. Okay. Right. So today we need to discuss the areas relating to this corporate finance and the risk management part. So in this module, right, as you all already know, so these are the key points that we need to cover under this corporate finance and risk management area, right? And I know you all have covered the relevant subjects, right? The modules relating to this area. I'm sure you all have very good understanding about these key points, right? During this session, we'll try to revise what are the key points that you should consider. That you should familiar, you should understand, and how to apply these concepts uh, in this module, right? So this to do this case study, when you are answering the case study, what are the key areas that you should familiar with respect to this corporate finance and risk management uh, part, right? So which covers significant percentage of the module, right? And as you already know, the key points that we need to cover, so we should be familiar with this the evaluation part, right? So what are the different valuation methods, what are the techniques, models available to evaluate these capital investments, because when we uh, analyze this corporate finance part, that's a very significant and important area relating applicable for any organization, because all the organizations need to make corporate finance decision, right? So if I very quickly revise, because I know you all have completed these modules, and I'm sure you all have very good and thorough understanding about this area. Especially this finance part is not a challenge for the right for you all, which that means in few days, all I'm sure you all chartered accountants in few days, and therefore this finance part is definitely, generally, this is the easiest part, right? This is the easiest part for the chartered accountants. So therefore this is not a new part. It's not a new part, and so therefore it is uh, very simple, easy to revise this part, but very quickly, right? So in order to cover properly, so what are the key areas that you all should familiar relating to this corporate finance part? So we can very quickly revise that, because the main points we need to cover, how to evaluate capital investments. In addition to that, in addition to the application of these key techniques, because right, we all know this analysis entirely based on estimates. So therefore the accuracy of the decision, right, the final decision that we take depends on the accuracy of these assumptions, estimates we make, so which is the most difficult part in this analysis, in this study. So therefore, how to analyze the risk of this uh, this exercise, so that also we should know what are the different techniques available to analyze the risk, right? Certain techniques like sensitivity analysis and scenario analysis, you should know how to apply that. And in addition to that, especially in capital rationing situation, how to rank the projects in order to select the best projects. I'm sure you all have referred this study guide relating to this module, and there are also some good examples are given, and so you may be familiar with that. So very quickly we can even refer to some of these examples, so within this limited time. So we should know how to make this investment decision correctly. So which involve number of different stages, right? And after that, so how to identify the best combination of capital? So what is the best possible funding strategy? Because these are the key points in financial management, right? Corporate finance. In the corporate finance module, I know you all have covered these key decisions, right? So the how to take the investment decision correctly with proper detailed evaluation, and then the financing decision, right? So financing decision, how to identify the best combination of capital, so in order to finance the project, because all these factors directly affecting to achieve the objective of the organization. And in addition to that, the organizations have to face various types of risk, and in order to mitigate these various types of risk, what are the different strategies, what are the different techniques that can be used? That's also we need to discuss briefly, right? And uh, so in order to cover these key points, I have prepared some study materials. Maybe after the today's session, I will share this with the coordinator, so he will communicate. He will send you these materials, because in order to revise and discuss the key points, right? So the points included here, you can see that's fairly broad area, even though it's summarized into one page that include a number of very important parts, which include many detailed analysis, so which may not be possible to revise within this 3 hours session. So but therefore certain points I have prepared some additional materials. As I mentioned earlier, these are not new things for you all, right? So you all know these things, but for the benefit of anyone who just need to quickly revise this, so this will be useful, right? So the number of points included in this study guide, so I have summarized to this study material, right? Which will be shared with you. uh, so to start quickly, because you all know what is the main objective of corporate finance, because we know all the organization all the organization need to make finance decisions. Not only the organizations operate with profit motive, even the organization operate without profit motive also need to make finance decision. And you all know the objective. I need not to mention right at this stage, so which you have completed all the exams, and so it's not a sort of, otherwise if when I try to explain these very basic things, some of you might feel like I'm trying to insult you, right? So you should not think like that. This is just to revise for the benefit of anyone. So because when I discussed with the former, my friend Mr. Sanjay Bandara, so asked me to do this session. So he said it's better to quickly revise the basic concepts also, and then move to the key areas in this part, the evaluation of investments and the financing decision, so that part, and the risk management, so that part we can uh, discuss the key areas, right? And you all know the objective, so to maximize the shareholders wealth of any organization, so they all need to make these important financing decisions, right? So when they are going to make this financing decision, so these all these decisions will involve risk. So subject to the risk involved in all these financing decision, it is necessary to select, right? It is necessary to do the best uh, decisions in order to achieve this main objective, right? And to achieve this main objective of the shareholders wealth maximization, right? Maximization of shareholders wealth, you all know several important decisions should be made, and those are the key areas included in this module, right? So you all know the key finance decision, uh, and so that is how what long-term investment should you make, so which we call investment decision, or sometimes it's called capital budgeting decision, right? So sometimes it's not sometimes, it's actually considered as the most important decision. because if this decision is wrong, whatever the accuracy of the subsequent decisions we make, so organization will not be able to achieve the main objective. So therefore, this investment decision should be made accurately with detailed evaluation. So that's why it is included as the the first and important point, because all the organization should apply the correct valuation models and analyze the risk in the study and select the correct investment. So that is the most important part. Unless the correct investment is selected, the organization will not be able to achieve the objective, right? And once the investment is selected, right? Once the investment is selected, then it is necessary to identify how to finance. So what are the different sources of finance that can be used, right, to fund these investments, and that also will help to achieve this main objective. And sometimes this third point, which I have included here, interpreted differently in different finance books. Because once the investment is selected, then it is finance. The next stage would be to take the short-term proper finance decision. That means the decision, that means the project should be selected, it should be financed, then it should be continuously managed. So that's why generally these three decisions are known as capital budgeting, capital structure, and working capital management. But these also interpreted investment, financing, and dividend decision. So which is definitely another right way of interpreting this, which is also right accurate, because we know definitely the dividend decision is important part, right? Very important decision that all the organization should take correctly, properly, which will definitely affect to the main objective of the maximization of shareholders' wealth, right? But sometimes it is argued dividend, that's not a separate decision, right? It's a part of financing decision, because once the organization generate profit, then it is necessary to decide whether to distribute the profit or whether it should be retained and reinvest. So when the organization make that decision, right? So it's considered as a part of the financing decision. So this classification, right? So this interpretation indicate the different stages of financial management. The project should be selected, should be financed, and then it should be continuously managed. Right? And so here main focus of this session is to discuss these two main stages: investment and financing, investment and financing decision, and in addition to that, the risk management, right? The risk management part, because today we know when organizations going to make these financing decision, we have to face various types of risk. And to minimize this risk, what are the different techniques, right? What are the different alternatives that the organization can use, right? So these point also we need to discuss, right? So here, especially relating to these finance decisions, right? Various types of risk, and the main risk that have been highlighted in this study guide, and also when we refer these pre-seen study materials for this one this year also, and generally other examples given in the study guide also, this foreign exchange risk, so that has a very high importance, so very significant very important part of these various types of risk relating to the exchange rate risk. And so that also we'll discuss, especially when you are analyzing a particular company relating to this case study. So this foreign exchange risk, that's a very important part. So we should know what are the various types of risk that we have to face with respect to this foreign exchange exposure, and what are the different strategies available for the organizations to mitigate, right, to minimize these various types of risk, right? So those are the key points that we need to discuss. And so this investment decision, I think I don't need to discuss in detail. I think you all familiar with that, right? You all familiar with these different techniques available to evaluate capital investments. Am I correct? So these different techniques. What are the different techniques? Very briefly, if you mention, what are the different techniques available to evaluate capital investments? Yeah, what are the different techniques? So the very basic. Sometimes, since the question is too basic, you're not willing to answer. Or what are the different models, techniques, valuation models available to evaluate capital investments? Generally, in these online sessions, you don't talk. Or so is there a restrictions to talk? Or right? So you all know the different techniques, right? What are the different methods available to evaluate capital investment, right? Because you have to apply, and you may have seen some of the examples given under this part in the study guide also. You need to apply some capital investment evaluation techniques. What are the different capital investment evaluation techniques? Some basic point, techniques, basic models to evaluate project. So during these sessions, you can talk, right? Because sometimes uh, I don't know whether these. So is there any restrictions to talk, or you have been
So
not
they
allowed
can
to
chat,
talk?
sir. They can chat.
Yeah. Sorry.
They can chat.
Okay. Only chat. Okay. Uh, all right. So okay here. Only chat option, right? Okay. So then. Okay, I mean, what are the different techniques? What are the different techniques available? Evaluation techniques available. Uh, right. The cash flow. Okay. Now I got some answers, right? Because here there are a number of answers. Cash flow method. Because cash flow is one way of estimating, right, the benefits. But techniques means here I can see some correct answers like net present value, payback period, and internal rate of return. Right. So here most of the answers relating to NPV and payback period. Okay. Now I can see IRR and profitability index. Okay, ARR. Okay, now okay, that's good, right? So these are the techniques available. uh, mainly so the techniques available, uh, some simple techniques, some if we start with very basic techniques. ARR, accounting rate of return. So I can see some answers, accounting rate of return, and then payback period. So those are the simple techniques, but that include many limitations, right? So the better techniques, as you mentioned, these net present value, internal rate of return, and some of you have mentioned even about profitability index, which is especially useful when there is a capital rationing situation in order to rank the projects, right? So therefore, these are the techniques, and so without spending too much time. So because here I have prepared a summary which I'm sure you all know these things very well, right? So in order to evaluate this capital investment, so these are the key techniques that can be used, right? But here I have not included the profitability index. Why? Profitability index is actually, rather than evaluation technique, it's a uh, in capital rationing situation, it is used to rank the projects, right? In capital rationing situation, we use profitability index to rank the projects in order to compare the projects. So that is the correct method, right? Okay, so you all know this thing. I think we don't need to discuss in detail. So these main techniques. So you should know how to calculate these values, right? ARR, payback period, NPV, and IRR. So you all, I'm sure you all know how to do this, because when you get the information about certain projects, so you should know how to calculate these values. And the calculation of these values are fairly simple, right? Nowadays, especially with this Excel and with the financial calculators, the calculation of these values so easy, right? So simple. But the more important thing is the interpretation of these results, because once we calculate these values, right? So you know the method of calculating these values. We should know how to interpret the results. How to interpret the results, right? That means how to decide whether a particular project is acceptable, right? So when you calculate ARR, it should be compared with RRR, required rate of return. So if the ARR is greater than the required rate of return, the project is acceptable. If we calculate the payback period, which is very useful for a particular organization, right? But the payback period, when we calculate, it should be compared with a benchmark period, cutoff period, right? Minimum acceptable period for a project. And then if the payback period of a particular project is less than the cutoff period, the project is acceptable. And when we calculate NPV, it should be positive. When we calculate IRR, IRR should be greater than the cost of capital, right? So these decision criteria uh, should be used to decide whether a particular project is acceptable or not. And the calculation of these values fairly simple, right? You all know these things, right? But we should also know what are the limitations of these techniques, right? Different techniques. ARR, very simple method, but it ignores some fundamental principles in project evaluation, because it does not consider the time value of money. So therefore, it's not a good technique, right? And in addition to that, it violates another key principle in project evaluation. Because when we are going to apply these different techniques, right, one thing is so important. We should know what are the key principles of project evaluation, because generally when we are doing this the example certain modules earlier, right, because you get the question with all the data, and it's just matter of calculating NPV, IRR, which is fairly simple, right? But when you are especially when you are doing a study like this case study, and when you are doing practical investment decision, we should know principles properly, right? It is necessary to know these principles correctly in order to do the proper analysis. Because we and that's what I saw when I see these answers given in chat books, right? When I asked about these evaluation techniques, there were a number of answers. Cash flow method, right? So uh, cash flow method, right? And because that include one principle. When we are going to do the evaluation of a capital investment, one main principle is decision should be based on cash flows, right? Decision should be based on cash flows. That is one very important principle when we analyze a project. So that's why ARR is not a very good technique, right? ARR is not a very good technique. Why? There, the decision is based on what? The decision is based on profits. The decision is based on profits, right? So that's violates, right? That violates one important principle. So that's why earlier you indicated when I asked about techniques, cash flow method. Cash flow actually, rather than a method, it is one principle we have to consider when we are evaluating a capital investment. The decision should be based on cash flows, not profits, because you know very well why profit is not the correct measure to evaluate a project, because you know very well as the chartered accountants in few days, right? You know very well profit is based on what? Profit is based on accounting policies, accounting principles, right? And in order to make certain accounting adjustment, the management has the right to decide the relevant accounting policy. So here I'm referring to accounting policies, right? Accounting concepts, no options. Accounting standards, no option, right? But accounting policies, but that also should match with the relevant accounting concepts, right? Because when a particular organization is going to uh, select a particular accounting policy to make accounting adjustment, right? Now, for example, depreciation, inventory valuation, making provision, various types of provisions, right? So all these, policies should be based on what? The relevant accounting concepts, matching concept, prudence concept, right? So based on these, it is necessary to select, but the management has the right to decide which accounting policy is most suitable for a particular organization, which will affect to the profit of the organization. And so therefore, ARR is not a good technique since it uses profit to evaluate a project. But one key principle that we should consider in the evaluation of capital investment decision should be based on cash flows. And that's why these other techniques use cash flows, right? NPV, IRR, payback, all these techniques use cash flows to evaluate a project. But ARR, very simple technique, but serious limitations. Uh, right, then the payback period, which is another very simple technique. The calculation is very easy, so it's necessary to identify how long it takes to recover the investment, which can be calculated so easily, but the limitations are there, right? That again, the normal payback period, we don't consider time value of money. And in addition to that, uh, probably the biggest disadvantage, the limitation of payback period, the cash flows after the payback period are not taken into account. And due to that, it is not a good technique when we are ranking projects. When we compare different projects, payback period is not a good technique because it indicates how long it takes to recover the investment. But it does not indicate whether the project is profitable, right? Because when we when we don't have information to identify whether the project is profitable, we can't identify whether it helps to achieve this objective. Because in order to maximize the shareholders' wealth, the more important cash flows are the cash flows after recovering the initial investment. So therefore, it is necessary to identify whether a particular project is profitable. But payback period technique does not indicate that, right? It indicates only the time required to recover the investment. So it's not a good technique to take the final decision of accepting or rejecting the project. In addition to that, especially it is not that is not a good technique to rank the projects, compare the projects. Payback period is not a good technique. And in addition to that, you also know very well this cutoff period, this benchmark. So that is also decided by the management, which does not have particular principle basis to decide this cutoff period. So therefore that can lead to various issues, right? And you have learned in finance about this agency conflict, right? Agency conflict, and especially this payback period technique can lead to this agency conflict, right? uh, and the better techniques are NPV and IRR. You all know how to calculate NPV and IRR, right? And when we calculate this NPV and IRR, uh, generally, for when we are evaluating one project, there will not be any conflict, right? There will not be any conflict between NPV and IRR ranking if we evaluate a single project. The reason, if the NPV is positive, that means what? That means IRR is greater than cost of capital. IRR is greater than cost of capital means NPV is positive, right? Because at IRR, you know the meaning of IRR very well, right? Very useful technique, very useful concept in finance. IRR, which is used in many analyses, not only in the evaluation of a project. When you are analyzing a financial instrument, we can use IRR. When we are calculating cost of capital, we have to use IRR, right? When you analyze debt instrument, we have to use IRR, right? Now, for example, when you are evaluating a bond, we can use IRR. What is the IRR of a bond? So if I ask simple question, IRR of a bond means what? What is the term used, right? The another term used for the uh, IRR of a bond. That's correct, right? Someone has given the answer directly. That's not break even rate, but someone has given the exact term, yield to maturity. Yield to maturity, right? The proper term, YTM, yield to maturity. So that is the IRR of a bond, right? If we mention only yield, that is not enough, right? So it is yield to maturity, because yield is the, that's another term used for the return, right? That means sometimes even to calculate the price of a bond, we have to use a particular rate, right? Generally we call required rate of return for that. uh, Sometimes we use the term yield, but IRR of a bond means yield to maturity, YTM, right? So that's, I can see many answers which indicate you will have the proper understanding about this, because yield to maturity, that is the IRR of a bond, right? So IRR, that's a very useful concept which we can use. Uh, Okay, so that in the chat box, someone has asked whether it's possible to share the Excel sheet also with the PPT. Yes, because this Excel sheet I particularly prepared after considering the content of this part, because that will be useful uh, for you to revise quickly, because I have included the key points relating to this. Uh, you know this part of the case study, right? So the evaluation techniques, and in addition to that, okay, so I'll explain these points also, and what are the main principles, and sensitivity analysis, capital rationing, and the cost of capital. In addition to that, some basic concepts related to derivatives I have included. I will share this at the end of the session. I'll send in I'll send this to the coordinator, and so they'll share with you, right? So here, so these techniques uh, should be applied with the proper understanding, right? And I mentioned one point earlier. If IRR of a project is greater than cost of capital, that means definitely NPV is positive. Because IRR, you know the meaning. IRR is the discount rate at which NPV becomes zero. If the NPV is zero at IRR, if the cost of capital is less than that, which means definitely NPV is positive. So IRR is greater than cost of capital of a project means NPV is positive, which means there is no conflict between NPV and IRR technique, the decisions given by these two techniques. But there can be issue, right? There can be an issue when we compare projects, when we analyze, especially when we evaluate mutually exclusive projects. There can be a conflict. In that case, the best thing is to use, I think you know the concept called NPV profile. NPV profile. So which shows graphically the relationship between the cost of capital, right? The discount rate and the net present value, right? So the graphical presentation, the graphical illustration now, the relationship between cost of capital and NPV is called NPV profile. And when you draw the NPV profile of two projects in the same graph, then it is possible to identify whether there can be a conflict between NPV and IRR rankings, right? Sometimes there can be a conflict between NPV and IRR rankings, right? For that, I use very simple example here, right? Just to explain that point, right? But when we use very simple example like this, because sometimes uh, when you are going to evaluate, when you are going to analyze several projects, you should know how to compare this, right? How to compare. And uh, when if we get the cash flows of two projects like this, right? So I will not spend time to do this calculation, basic calculation, because you all know very well. So how to calculate this payback, NPV, IRR, different methods, right? Different methods, because NPV, you can calculate using this detailed formula, or you can calculate using the interest factor this using tables or using Excel simple formula, right? Because when you apply the discount factor, you can calculate the present value. In addition to that, if you use Excel using NPV formula, you can calculate. So number of methods, and in addition to that, the easiest way, you can use financial calculator. Nowadays, for the chartered exams, is it possible to use financial calculators? Financial calculators allowed or no? Yes, right? Ah, okay. Then with the financial, I mean not scientific calculator, right? I refer to financial calculator. Uh, with the financial, yeah, I think only scientific calculator, right? Because uh, as I know, financial calculators are not allowed for this.
Only the scientific calculator.
Only
Scientific.
yeah, only scientific calculator, right?
Yes.
Okay. So with the financial calculator, there is another method, but right, but we can calculate that so easily with normal scientific calculator, right? That can be done. So when we calculate NPV, you right for several projects. When you calculate IRR, so okay, if we can use only scientific calculator, especially to calculate IRR, we know what is the only method? What is the only possible method if we use only scientific calculators to calculate IRR? What is the only possible method? That is called, right? IRR. To calculate IRR, we have to use what? What is the method? We have to use trial and error. Yes, we have to use trial and error method, right? Because using that, IRR can be calculated. But that's also not a difficult thing, right? Because when we calculate initially, when we calculate the net present value using the cost of capital, we can easily uh, calculate IRR, right? But we have to use, we can calculate approximately when we use this trial and error method. But if we want to calculate more precisely, we need to do it several times, right? Because when we calculate NPV, now for this example, when these cash flows are given, right? So here the detail, the manual method I have explained for the first project, right? For the first project, it is explained. And when we calculate NPV, so the answer is 966 positive. If the net present value is positive at this current cost of capital 12%, we know definitely IRR of this project is more than 12% or less than 12%. Right? I've asked very basic questions, right? So you should not, right, think bad about it, right? So it definitely more than cost of capital, because at cost of capital it is positive, means definitely IRR is greater than that. So we need to try a higher rate. So that's why when we use 12%, now we may have to use higher rate, 20%. And especially we can use any two rates and calculate IRR. But here the relationship between NPV and the cost of capital is linear or non-linear. The relationship between cost of capital and the net present value is linear or non-linear. Right? There are a couple of answers. Linear. Is it linear? If it is linear, any two rates will be all right, right? But it's not linear. It is non-linear. And especially, when we see a formula like this, definitely what will be the relationship? Definitely it will be non-linear, because here there are different powers, right? And therefore the relationship is not linear. This is not an equation for a straight line. So definitely the relationship will be non-linear, negative and non-linear. And that's the reason we get only approximately correct answer. Otherwise, if it is linear, any two rates, we can get perfectly correct answer. But here, why we get only approximately correct answer, the relationship is not linear. When we used to, and that's why generally to calculate IRR, if we get positive answer for the first calculation, it's better if we get negative answer for the other rate. Then only the answer will be close to the most, the perfect answer. Otherwise, the accuracy is low. But with Excel, the calculation of IRR is so easy because IRR inbuilt function is there. It's just a matter of selecting the cash flows. But since uh, if we are going to do it manually, so this is the method which we can calculate, right? But here you can see the manual method, even with 8% gap, we get fairly close answer to the perfect answer. So calculation of IRR is not difficult, right? IRR can be calculated easily. And here I use the same example, right? So I have used the same example to identify the relationship between this NPV and IRR. So when we calculate NPV and NPV at the current cost of capital and IRR using the cash flows, right, we get these answers. Now, so these are the NPV of the two projects and IRR of the two projects. So is there a conflict between NPV and IRR ranking for these two projects at the current cost of capital? Is there a conflict? There is no conflict, right? Because here we can see when we compare the two projects, the project with higher NPV is X. And when we compare IRR, the project with higher IRR is also X. That means there is no conflict. There is no conflict. But if the cost of capital change, because we know this analysis, as I mentioned earlier, this analysis is entirely based on estimates. And if the cash flows change, right? If the actual cash flow is different to this projected one, there will be a change, right? There will be a change in the initial value, right? Net present value. And if the cost of capital change, this will change. So that's why it is necessary to identify if the cost of capital change, can there be a conflict? The best thing to identify that without doing all the calculation, the best thing to identify that is to use this NPV profile concept. NPV profile, as I mentioned earlier, that illustrates the relationship between net present value and the cost of capital. And the relationship is non-linear, right? Relationship is non-linear. And when we draw the NPV profiles of two projects in the same graph, then it is possible to identify whether there can be a conflict, right? Now, when you see the NPV profiles of these two projects, right? So here, using the using different discount rates, so I have drawn this NPV profile, right? So these NPV profiles of the two projects I have drawn here. And when you look at this graph, can there be a conflict between NPV and IRR rankings at different cost of capitals? There can be a conflict, or there is no conflict. Is it possible? Yes or no to have a conflict? If the NPV profiles of the two projects, right, given in this graph, so there can be a conflict or there cannot be a conflict. What do you think? Yes, right? It's possible to have a conflict. It's possible to have a conflict, right? Why? The NPV profiles of the two projects cross each other. Then definitely there can be a conflict, right? And even it is possible to identify, because here we can see there can be a conflict between NPV and IRR rankings, because the NPV profiles of the two projects cross each other. Even to draw the NPV profile, because right, if we are going to do this manually, it's not easy to calculate NPV so many times using different discount rates, but we don't need that much of information to do to draw the NPV profile. That's fairly easy, right? So how can you draw the NPV profile? One important concept when we are comparing, especially when we compare mutually exclusive projects, right? To draw the NPV profile, it's easy. Now, for example, to draw the NPV profile for project X, we can start with zero cost of capital. If the cost of capital is zero, we know practically that's not possible, right? But if the cost of capital is zero, cost of capital zero means what? No need to discount. What is the net present value? Simply the difference between inflows and outflows. And total inflows for project X, 13,500. And investment is 10,000, which means definitely the net present value will be 3,500 if the cost of capital is 0. So if the cost of capital is 0, what is the net present value of project X? 3,500. And the other point, when the cost of capital increase, net present value decrease, right? Net present value decrease. And at this cost of capital, at this point, right? What is the value of NPV? At the point where the NPV profile crosses the cost of capital axis, right? What is the net present value? Net present value 0. If the net present value is 0, what is that rate? What is that rate? That is IRR, right? That is IRR. So the point where the NPV profile crosses the horizontal axis, right? Horizontal axis, that is IRR. So we need only two values to draw this rough, that means to draw this roughly, we need only 2 points. What is the NPV at 0 cost of capital? What is the IRR? Using these 2 points, we can easily draw. So for 2 projects, we can easily draw this to see whether there can be a conflict. So this is one good technique to compare, right? To compare different projects, this is one good technique. So we can see whether there can be a conflict. There can be a conflict when the cash flow patterns are different, right? So that's why, as you mentioned earlier, so here there is a possibility to have a conflict, right? So we can even identify the point where the NPV profiles of the 2 projects crosses, right? So what is the point? That the NPV profile of the 2 projects intersect each other, right? Cross each other. So that point we can identify, right? What is that point? Anyone knows how to calculate this point, this crossover point? Anyone knows what is the basis of calculating that, this crossover point? That is the IRR of incremental cash flows, right? So which is mostly not available in the books, but that is the IRR of incremental cash flows. Now, incremental cash flows, that means we can see investment cost, there is no difference. Incremental means the difference, right? So there is no difference in the investment cost. But other years, there are differences. These are the incremental cash flows for these 2 projects, right? Incremental cash flows. And if we calculate the IRR of these incremental cash flows, IRR of the incremental cash flows, that is the crossover rate. This is the crossover rate, right? At this rate, the NPV profiles of the 2 projects cross each other. How do you know whether that is correct? How do you know? Because you should not accept just because I mentioned. We should be able to check that, right? Because here I have calculated these values giving formulas, right? So here these values have been calculated at the current cost of capital. And we know if the cost of capital change, this NPV will change, right? NPV will change. And to see whether this is the correct crossover rate, what we can do, we can use this as the discount rate. And if that is the correct crossover rate, what should happen? What should happen? At that cost of capital, NPV of the 2 projects should be equal. NPV will be same, right? It should be equal. So we can check that. So if we use this one, what should happen? These 2 figures should be same, right? Let's check. That's same, right? That means that is the crossover rate. Crossover rate. Crossover rate means what? That is the IRR of incremental cash flows. IRR of incremental cash flows. So when we need to compare, to identify if the discount rate change, because you know the meaning of discount rate, right? Discount rate means what? Discount rate means the cost of capital, right? Because that is another very important part of this module. Because that's a main part of corporate finance. We very simply use discount rate for many calculation in finance analysis. When you are analyzing finance problems, we simply use discount rate. But discount rate, what is the meaning? That is a very, very important point, which can be interpreted in number of different ways. What are the different ways you can interpret the discount rate? Discount rate, when you are evaluating a finance, okay, uh, right. So here there's a question. I'll answer that. And before that, so the point I was mentioning that uh, uh, yeah. So what are the different ways the discount rate can be interpreted? The discount rate means, okay, here, uh, okay, so one answer correct. It is the cost of capital, weighted average cost. Okay, here both from both angles the answer is given, right? It is the required rate of return. What is the minimum required rate of return? The cost of capital, and the proper term, weighted average cost of capital, right? So number of correct answers here, right? And from because when we are evaluating, not only evaluating project, right? Now, for example, in order to calculate the price of a financial instrument, you want to calculate the price of a share or price of a bond, we have to use discount rate. Discount rate represent what? From the investor's point of view. From the investor's point of view, it is the required rate of return, right? So here, that's correct, required rate of return. And okay, this is the meaning. The meaning correctly explained here. Minimum return we require. What is the minimum return you require when you are going to make an investment? What is the minimum return you require when you are going to make an investment? Okay, this is another correct term. That's very good. Opportunity cost. Opportunity cost, which is the cost of capital, right? So therefore, this discount rate can be interpreted in number of ways, right? Discount rate can be interpreted in number of ways when we are evaluating different types of financing decisions, right? We can interpret this in number of different ways. So you mentioned all the correct terms, right? So correct term, discount rate, which means the required rate of return. Required rate of return. What is the minimum required rate of return? The cost of capital. And the other very correct term also, right? I saw the answer, the opportunity cost. Opportunity cost, which is applicable from both sides, right? That means from the investor side, from the issuers or the organization side, right? So we can use this term, opportunity cost. Because whenever you are analyzing a particular investment, different investment alternative, when you are selecting the best alternative, right? So what is the minimum return we should get? The return that we can expect from the next best alternative. And that's why it should be better than the next best alternative. And that's why this opportunity cost, that term is very correct, right? That's why that term is correct. So it's very good that all the relevant terms I can see under the answers, right? That's good. So, okay, and there was a question using, uh, okay, uh, can you show again how did you get 6.22%? Okay, I'll show that. And there was another question. How can how we can come to the decision using NPV profile? Okay, like choosing the project or not. That's simple, right? Because here when we use the NPV profile now to identify this more clearly, I will use NPV profile of only one project, right? Because NPV profile shows the decision criteria given by both NPV technique and IRR technique. Because that's why I mentioned, if IRR is greater than cost of capital, what is the meaning? IRR is greater than cost of capital means NPV is positive, right? And that's the way, because here now this is the NPV profile of this project X. Now, what can we identify from this graph? We can see as long as the cost of capital is less than this rate, it is positive, right? Because we know the point where the NPV profile crosses the horizontal axis. Horizontal axis means cost of capital axis, right? We know this is what? This is IRR. This is IRR. And at any cost of capital less than IRR, what is the value? What is the nature of NPV? NPV is positive, right? when the cost of capital is less than IRR, NPV is positive. And this is IRR, and if the cost of capital is more, NPV is negative. So NPV profile, that's the decision criteria is same. Only thing that shows very clearly, right? Very clearly we can see the value, the way NPV change. So therefore, it's it helps to identify the net present value at different discount rates, right? The criteria is same, and here that shows much more clearly, right? Uh, how to identify the range, right? The range that the NPV is positive. So as long as the cost of capital is less than IRR, right? NPV is positive. So that's why now within this range, now when we use this range, right? Now this range, within this range, what is the condition? So within this range, we can see cost of capital is less than IRR. If the cost of capital is less than IRR, NPV is positive. Beyond this point, cost of capital is more than IRR. If the cost of capital is more than IRR, NPV is negative, right? So that is the that is how we can decide. Okay, that was a question to show how I calculated this crossover rate. That is actually, we need to get the incremental cash flows. When you are evaluating two projects, right? When you are analyzing two projects, to identify the point where the NPV of the two projects equal, right? In other words, the point where the NPV profiles of the two projects cross. If, right? Because this is not the case all the time. This will happen, this is another point. That's why here I use very simple example, but using this simple example, we can understand number of important concepts related to the investment decision, right? So that's why I use this, even though I know you have done many, right? So that's why I mentioned earlier, you need to tolerate when I use very simple basic examples, right? Because I know uh, so you have completed all these modules earlier, you know very well, right? But just to revise, I have included this. And here, the method of calculating this crossover rate, we have to see the incremental cash flows. Incremental cash flows. Here, investment, there is no difference. Incremental, because that is also one key principle when we are evaluating a project. I will discuss that in few minutes. Here, when we compare these two projects, the incremental cash flow, right? So this shows the incremental cash flows for all the years. Investment, there is no difference, and right, and from the first year there are differences, and therefore this shows the incremental cash flows, right? So these are the incremental cash flows, and we need to calculate IRR of the incremental cash flows. So this is 6.22% means what? It is the IRR of incremental cash flows. Incremental cash flows. And if you calculate manually, now these cash flows we need to, for these cash flows, we have to calculate IRR, which means we have to use two rates, and using that manual method, right? Using this manual method, we need to calculate. Right after calculating the net present value for these cash flows, right? Using two rates. But with Excel, that is so straightforward, and that is the crossover rate. That's how you calculate IRR of incremental cash flows, right? It is the IRR of the incremental cash flows, right? So this NPV profile this concept that provide useful which project has the highest IRR, we can select through NPV profile. We can identify which project has high IRR, right? Using the NPV profile, that's possible, right? Because the point where the NPV profile crosses the horizontal axis, that is the IRR. So we can identify, because that means Now, under this current condition, that means when we use the current cost of capital, there is no conflict. The project with higher NPV also has higher IRR. So there is no conflict. Now, this NPV profile is important to see the impact if the cost of capital change. Because cost of capital, cash flows, everything, these are estimated values, projected values. And that's why this NPV profile is important, right? And IRR, I mentioned earlier also, that's a very useful technique. And I mentioned about ranking projects in capital rationing situation. In capital rationing situation, for ranking the projects, what is the technique that we can directly use out of these four techniques? Out of these four techniques, what are the techniques that we can directly use to rank the projects, compare the projects? Okay, there is one answer, NPV. NPV. Is it possible to compare projects using NPV? That is not possible. You know, for this example, it is possible. Why? Investment is equal. Investment is equal. But that is not the case all the time. That is not the case all the time, right? Because when we need to compare projects, the investment may not be equal. Investment may not be equal. And uh, okay, another answer is the payback period. Is it possible to compare project using the payback period? Right. So correct, some correct answers here. But I asked out from these techniques. Right. One technique we can properly use given in these answers, profitability index. That's correct. I mean, in addition to that, I mean, out of these techniques, what is the technique? What are the techniques we can directly use? Right? One answer is given, IRR and payback period. One technique is correct, one is wrong. IRR, yes. Payback period. Is it possible to compare projects using payback period? That is not possible, right? Okay, here to identify that, one simple example I have already given. Now, if there are two projects like this, if we calculate payback period, so these are the payback period, right? Two simple examples I have used, right? Uh, so these are the payback period. And if we are going to select the project using a payback period, what is the better project? A or B? From this simple example, what is the better project, right? If right, A, it is A. But is that the correct project? Is that the better project? Is that the better project? No, that is not the better project. You can see, even if these are discounted cash flows, here we can see only the investment can be recovered. But this one, that will help to achieve the objective, maximization of shareholders. But is there any benefit of accepting a project like this? There is no any benefit. So is it possible to rank the project using payback period? Payback period is not the correct technique to rank the projects. To rank the projects, the technique we can use as it is from these techniques is only IR. NPV also we can't use as it is. NPV should be used with investment cost. And that's why, right, there are a number of correct answers. We have to use profitability index, right? Profitability index. Because profitability index, that is a technique which use NPV concept with investment cost. With investment cost. And there are different formulas. Okay, here, even to compare projects, someone has given ARR, which is also not correct. I mentioned earlier also, ARR is not the correct technique to rank the projects because ARR is based on profits. And in order to calculate profit, when the organization get project proposal from the different parties, they may have used different accounting policies. So ARR is not suitable to rank the projects. Payback period, not suitable to rank the projects. NPV also not suitable to rank the project as it is because NPV does not indicate the investment cost. Because when we are comparing projects with different investment cost, NPV we can't use. NPV can be used only if the investment equal, like right now. In this case, possible because investment equal, but generally it is not possible. And that's why profitability index should be used. to calculate profitability index, there are different formulas, right? And so this is one method. NPV plus initial investment divided by initial investment. But when I see the study guide for this module, the profitability index has been calculated NPV divided by the initial investment. It has been calculated as a percentage, right? As a percentage. This is also possible, right? Because you know very well, having done many accounting and finance modules under this program, especially when it comes to these formulas, ratios, right? To calculate a particular ratio, there are so many different formulas, right? Equations. So it's all right as long as you use it consistently and you interpret it correctly. Now, for example, very simple ratio, quick ratio. You also call acid test ratio. How do you calculate quick ratio? Okay. Yeah, that is another good question. When the duration is different, can't we compare using equivalent annual cost method? That's correct, right? That's correct, because especially when we have to compare projects with different durations, right? It's necessary to use method like this, right? So equivalent annual cost method. Right. Okay. The other question I asked, quick ratio. There are a number of answers. Right. Most commonly used equation is given here, which is correct. Current assets minus inventory divided by current liabilities. That is the most commonly used one. Is that the only way to calculate the quick ratio? So this is what I want to highlight. Is that the only formula available to calculate the quick ratio? No, there are number of different formulas. If you right, when you refer different accounting books, you can see, because the purpose of calculating quick ratio to identify the real liquidity position of a company, right? Uh, okay, so here there is a question how to make the ranking using PI, right? Because because profitability index, whether you calculate this way or the other method, NPV divided by initial investment, uh, calculate as a percentage. So higher the profitability index, better. Higher the profitability index is better, because that shows the NPV with respect to the investment. So higher the profitability index, better, because that indicate, because here I will use the values given by included, because here I have not calculated examples here. uh, Right now, so you asked about profitability index, right? So now when we calculate, especially the profit, can we see now, is it possible to use NPV to rank the projects when the investments are different? When the investments are different, it is not possible. So NPV is not the correct technique to rank the projects, right? But what is the correct technique? Profitability index. When we calculate the profitability index, so these are the values. Okay. Otherwise, we can calculate as a percentage, right? Now, this is the method given in this study text uh, in the example, right? Now, whatever the method you calculate it, you get the same ranking, right? What is the best project? The project with the highest profitability index, right? Highest profitability index, right? Higher the profitability index, better, right? So higher the profitability index is better. So when we calculate the profitability index for different projects, right, we need to rank the projects using, right? So profitability index, higher the profitability index is better. Even IRR, that is the criteria. Higher the IRR is better. IRR, as I mentioned, it's very useful. Okay, can someone tell me what is the main limitation of IRR as an evaluation technique? There is a notable weakness in IRR. What is the main weakness in IRR? Internal rate of return. Uh, well, so here several answers there. Multiple IRR. It's a problem, but that's not a common problem, right? Very rarely that problem can arise. Unable to recognize the size of the project. Okay. Capital reinvestment is not considered. Calculation complexity. Okay, this is the correct answer. This is the correct answer. Someone has given the correct answer, right? Because the previous points are not actually the biggest weakness, because uh, multiple IRR, it's a it's a limitation, but very rarely that issue may arise, right? But calculation complexity, that cannot be considered as a weakness. That's a bit difficult, yeah. But this is the correct answer. Reinvestment assumption. Reinvestment assumption, right? That is the issue, because it is not realistic. Because whenever, right, that is the yeah, this is correct. So number of answers given, we assume cash flows will be reinvested at IRR. That's correct. That's the limitation. That is the biggest limitation of IRR. The reinvestment assumption is not realistic. Here the main limitation of IRR, reinvestment assumption, is not realistic. The reason, it is assumed that the initial cash flows are reinvested at IRR, right? Because these are also problems, but not not common problems. Very rarely, when there are unconventional cash flow for a particular project, these issues can arise, right? So the biggest problem right now, from this simple example also, we can see that issue. Now, for this company, the cost of capital is 12%, and when we calculate IRR, we get these values. Now, what is the assumption? It assumes that now for the first project, it is assumed this initial, initial cash flows can be reinvested at 18% when the cost of capital is 12%. Because we know the cost of capital is estimated using this current information, right? So the market interest rate is around this one. It will be less than this, right? Because this will be the weighted average cost of capital. Generally, the cost of equity is higher, right? And therefore, this uh, the current market interest rate is definitely less than 12% also. Under that condition, it is assumed that these initial cash flows can be reinvested at 18%, which is not correct, which is not realistic. That's the issue. That's the main issue with IRR. But this value is so important, right? So important. Why? Because this indicate what? As long as the cost of capital of the firm is less than IRR, this project is acceptable. Project will generate positive net present value. So that's why IRR is useful. If the IRR is significantly greater than cost of capital, that indicate what? That indicate it is safe to accept this project. But if the IRR is very close, right? If the IRR is very close to the cost of capital, that indicate it's very risky to accept that project, right? Now, okay, so if we have two projects, and if the right, so now suppose the cost of capital for this firm is 11%, right? 11%, and if we get these values for two projects, right? So what is your recommendation? Which project should be accepted? Which project should be accepted? The cost of capital is 11%, and these are the values, right? Okay, there are several answers. B, right? And even the acceptance of B, is it very profitable project B? You can see IRR is marginally above the cost of capital. So is it safe? Is it safe to accept? Right? Right? Is it uh, uh, it's only marginally above the cost of capital. So therefore, it's not very good project, right? So here some few things, right, relevant for the valuation of investment. So here some key techniques, but here we don't need to discuss this in detail. There are a few more points, and very quickly, we'll I'll describe some key principles relating to the project appraisal. That's the important thing, because when you get some detailed information relating to a particular company, that's why I mentioned not like the exam question, because exam question, the information may when the question is for the project evaluation, all the information will be there, so we can easily do that. But especially when you are analyzing a case study, so it is very important to know the principles, right? Because we should identify only relevant cash flows. Because earlier I mentioned one key decision is, right, one key principle is decision should be based on cash flows. And what are the relevant cash flows? Relevant cash flows are the incremental cash flows. So that is a very important point when you get the information about a particular project. So you have to see whether that cash flow is relevant for the evaluation, for the analysis, right? Relevant means, relevant does not mean there should be actual cash outflow or actual cash inflow or the cash movement. That is not the meaning. But it should be incremental. Incremental means what? Due to the acceptance of the project, there should be a change. And that is the key principle. The cash flow will be relevant only if it is incremental. Another term, differential, right? In addition to that, because there can be certain cash flows, whether the project is accepted or not, it cannot be changed, right? So that's what you call sunk cost. If there is a sunk cost relating to the project, right, that you analyze, that should be excluded. That is not relevant, because sunk cost is not incremental. Sunk cost is not incremental, right? So therefore it should not be considered. So when you are evaluating a particular project, if there are any information relating to a maybe feasibility study, research and development, so those are not relevant, should not be considered for the evaluation, because those are sunk cost, will not, that is, will not be able to recover whether the project is accepted or not. Okay, and this is another important point, especially when you get the information relating to a company. And so even in this pre-seen material, I saw the organization engage in many different businesses, industries, right? And when you are evaluating a particular project, it is important to identify whether a particular project can affect to the other operation of the business, right? And that is called externalities. Externalities, right? Externalities. There can be positive externalities, negative externalities. Externalities should be considered. Why? The cash flows that will arise due to the externalities are incremental, because these externalities will be there only if the project is accepted. If the project is accepted, there will be a change, right? Not only the cash flows relevant to the project, but the other operation of the business, other projects, which you can relate to some economic concepts also, right? Now, for example, when the organization introduce a new product, right, from this new project, due to the introduction of the new product, the demand for the existing products can change. It can increase or it can decrease, right? Which you can relate to some economic concepts. Suppose the new product is a substitute for some of the existing products. There will be positive externalities or negative externalities. There will be positive externalities or negative externalities if the new product is a substitute for some of the existing products. There will be positive externalities or negative externalities. There will be negative externalities. That's correct. Because if it is a substitute, due to the introduction of the new product, the demand for some of the existing product will decrease. But if the new product is a complementary good for some of the existing product, there will be positive externalities. So externalities should be considered. And especially when the organization is using its own resources for a new project, right? So that is useful thing, because maybe organization is going to use its own building to start the new project, right? There is no any additional cost. Maybe the factory or the building already constructed, but there will be opportunity cost. So the cash flow should be evaluated on opportunity cost basis, right? The cash flow should be evaluated on opportunity cost basis. So that's why I mentioned earlier, the important thing is not whether there is actual cash movement, but whether the cash flow is incremental, right? So that is the most important point. whether the cash flow is incremental. So that is the important part. Okay, and the cash flow should be incremental, and opportunity cost should be considered. And you know very well, another very important thing, when we use cash flows to evaluate a project, always we have to use which cash flows? We have to use after tax cash flows, right? So cash flow should be estimated on after tax basis. Time value of money, which is a fundamental concept you apply from the beginning of the finance module. So therefore, you know very well, timing of the cash flow should be considered, which means the time value of money should be adjusted. And if the company is going to finance the project or part of that using debt capital, you know very well, if the debt capital is used, what is the cost of debt? The company has to pay interest. So the interest payments for the debt capital that the company has raised to finance the project, these interest payments, right, should be deducted or should not be deducted when calculating the cash flows for the project. Okay, here there is a question. Can you explain again externalities with an example? Right. Okay. Externality means actually when the organization start a new project, whether the new project can affect to the other existing operation, existing products, right? Because when the new product is introduced, if the demand for the existing product decrease, there's a special term for that also, right? I'm sure maybe in management or marketing, you may have used that. Due to the new product, if the demand for the, that's correct. Here, the correct term is given here, cannibalization. Cannibalization. So due to the new product, due to the introduction of the new product, if the demand for the existing product decrease, that is called cannibalization. Negative externalities. Negative externalities. These externalities we learn even in economics, right? Yeah, I'll explain interest cost also, right? Externalities, I remember we learn even in economics in school. School, I remember our economics teacher, අපේ මල්ලිකා ටීචර් කිව්වේ බාහිරතා කියලා. ඉස්කෝලේ. Right? බාහිරතා. Externalities. Right? මල්ලිකා ටීචර් නම් කිව්වා there are right දන්න බාහිරතා රින බාහිරතා. Positive externalities, negative externalities in production, consumption. So in economics we learn in detail in school, right? But here when we are considering a project, if the new product is a substitute, right, for the some of the existing products. Now, for example, Coca-Cola introduce a diet version of a particular drink. So what will happen? So due to the introduction of this product, the demand for some of the existing product decrease. Negative externalities. When I discuss this in a particular class about positive externality, complementary good, right? So one answer was, right, company that produce maybe Iraq, so they start to produce bikes. What will happen? Due to the new product, the demand for the existing product also increase, right? So that is positive externalities, right? Positive externalities. So therefore, and here what we should consider, if the new product has any particular relationship, maybe positive or maybe negative, and due to that, if there is an impact to some of the existing products, existing operations, that should be considered, because that is incremental. Due to the introduction of the new product, there will be a change in change means it may be increase in revenue or decrease in cost, or decrease in revenue or increase in cost, whatever. Incremental cash flows should be considered, should be estimated, right? So therefore, externalities should be considered. Externalities should be considered. Can you explain interest cost? Yeah, because that's what I try to explain. Now we know when we are calculating these cash flows, right? We should deduct the cash revenue minus cash expenses, and when we, in order to get this net cash flow, if there are any interest payments, these interest payments should be deducted or should not be deducted. in order to calculate the net cash flow after tax, the interest payment should be deducted or should not be deducted? Right. So correct answer given, should not be deducted, which is correct. Right. Should not be deducted. Why? The reason, right? Because here, when we estimate the cash flows for the purpose of evaluation of a project for this objective, right? This is not for the preparation of income statement for a company based on the historical data, right? But here, for the purpose of evaluation of a project, interest cost should not be deducted. Why? What is the reason? Because when we estimate the cash flows, what we do? We discount. We discount, right? And what is the discount rate? Discount rate means what? Discount rate means cost of capital. Cost of capital, and you mentioned earlier also, what is the proper cost of capital to discount? Here, the correct answer is given, weighted average cost of capital. And if the company uses debt capital, that already incorporated. That's already incorporated. And you know very well, right? I have included one point relating to the estimation of this cost of capital also, right? We can discuss there, right? So therefore, the cost of capital, the discount rate, include interest cost. So therefore, interest cost should not be deducted. So that is another main principle in the evaluation of a project, right? In the evaluation of the project, finance cost should not be deducted since it is included in the discount rate, as you have very correctly given, mentioned here. Uh, so here we should not deduct the interest cost because because here the point I asked, because okay, here if we discount cost of equity, the discount rate finally is the weighted average cost of capital. So therefore, the cost of equity also we calculate. Cost of equity and everything is incorporated here. I will describe that in few minutes, right? Because here, as a number of correct answers given here, the correct discount rate is weighted average cost of capital. So therefore, that include everything. That include everything, right? So when we use the weighted average cost of capital, the cost of debt is already included there, right? So therefore, when we are going to evaluate the project, these cash flows we discount. We discount. If we deduct interest cost and if we discount, that is not correct. Then what happens? There will be double count, right? So that interest cost is adjusted twice, which is not correct. So therefore, the interest cost should not be deducted. Interest cost means, like that's why I specifically mentioned earlier, the interest cost relating to the debt capital that the organization used to finance the project, right? Interest cost used to finance the debt capital requirement of the project, right? Should not be deducted. Should not be deducted. And another important principle related to inflation, because we know inflation is a factor that can make significant impact for this analysis. Inflation can affect to the cash flows. Inflation can affect to the discount rate, right? Because you know very well, when we estimate the cash flows, we can estimate the cash flows with inflation or without inflation. When the information given, right, okay, this is the current price level and this will be the price of the product based on the current information, but this is the average inflation for this country. So therefore, the price of this product will be increased with inflation, right? If we include the inflation to the analysis and estimate the cash flows, what are the cash flows? Because you know these two concepts, right? You know the two concepts, the value with inflation, without inflation. Okay, here the correct term is given. If we estimate the cash flows with inflation, those are nominal cash flows. The correct answer given here, right? If we estimate the cash flows with inflation, that is nominal. If the cash flows are nominal, what should be the discount rate? Discount rate should be nominal, right? We have to use nominal cost of capital or nominal required rate of return. But if we estimate the cash flows without adjusting the change in the price level, that means this is the current price level and we are going to estimate the cash flows based on the current price level. which means, right, we considering constant prices, and we estimate the cash flows. Then what are the cash flows? If then the cash flows are real. That's correct, right? Then the cash flows are real. If the cash flows are real, what should be the discount rate? The discount rate should be real, right? So we have to discount the cash flows using real rate. And you know how to convert nominal interest rate to real interest rate to nominal, right? What is the formula you use? What is the formula? Very famous, right? The formula that used to convert nominal rate to real or real rate to nominal. Yeah, Fisher formula. That's correct, right? Using the Fisher formula, you can convert the cash flows, right? And so using that, it's possible to right, it's possible to adjust this inflation, right? Which is very important part, right? Which is a very important part. This real interest, right? Real interest using this is the approximate condition, right? Nominal rate equal real rate plus inflation, right? But the exact method, as you correctly mentioned, Fisher formula. Using the Fisher formula, we can convert real to nominal or nominal to real, which is very important when we are analyzing a project, right? When we are analyzing a project, that is so important, right? So we should treat this inflation consistently. If the cash flows are nominal, discount rate should be nominal. If the cash flows are real, discount rate should be real. So it is so important to follow these principles, right? It's so important to follow the principles when we are evaluating a project, right? Okay, and so you all know how to calculate and interpret, and especially in capital rationing situation, I already mentioned about this profitability index and IRR. So using these two techniques, even some of the examples given in the study text relating to this uh, project evaluation, right? So when there are information related to different projects, it is not correct to rank the projects using NPV. See, so especially when we get the details of several projects like this, it is not correct to rank these projects based on NPV. You can see the initial investment that is not equal. When the initial investment not equal, it is not correct to rank the projects using NPV. NPV concept can be used only with investment cost, and that's why we need to calculate profitability index. Otherwise, we should use IRR, right? So in capital rationing situation, to rank the projects, we should do the ranking using either profitability index or IRR. It is not correct to rank the project using NPV. We can see clearly the investment cost different. When the investment cost different, it is not uh, uh, okay. Here there is a question. Unless the question specifically mentioned, we have to consider the cash flows as nominal. Oh yes. Okay. And otherwise it should be specifically generally, if it is not specifically mentioned, that indicate the cash flows nominal, right? And there may not be any adjustments relating to the discount rate, because if it is not specifically mentioned. Okay, can you explain Fisher formula again? Okay, Fisher formula, that's I'll explain. And sensitivity analysis is another method. Sensitivity analysis, actually, that is a technique used to analyze the risk of a project, not ranking, right? It's not a technique used for the ranking. Sensitivity analysis, that's a technique you used to analyze the risk of a project. Because when we calculate with these values, NPV, IRR, when we calculate these values, that doesn't mean this project will definitely generate this value. That is not the meaning. Now, for example, when we calculate these values for these projects according to the initial estimates, right? We call base case. Initial estimates, when we do this calculation, does this mean this project X will definitely generate a net present value of 966. Is that the meaning? That is not the meaning, right? Why? The analysis is based on estimated cash flows and the estimated discount rate, cost of capital. So therefore, this is also estimated value. But I will use an example to explain this sensitivity analysis. For that also, I have included one simple example here, right? One simple example is given here to understand sensitivity analysis, which is one important point given in this study text. We should have the proper understanding about sensitivity analysis. Therefore, it is mainly it is mainly risk management technique, right? So it is a technique used for the analysis of a risk of a project, especially when we get certain values very close values. It may be marginally positive, IRR only marginally above the cost of capital, then it's risky to accept that project. So then what we should do, right? Actually, not only under those conditions, generally when we do the initial analysis, it is important to analyze the risk of the project. Okay, and Fisher formula, that's not a difficult one. So this Fisher formula, and it's important because this especially when there are some information relating to the investment in some other countries, right? This will be useful especially to adjust this discount rate when different currencies are involved. So you have to use this international Fisher formula, and using that, it's possible to estimate what will happen to the exchange rate, right? So can be calculated, can be estimated. So using this international Fisher formula, and this interest rate parity formula, using that, it's possible to estimate. Right now here, so okay, this Fisher formula, that's 1 plus nominal interest rate equal 1 plus real rate into 1 plus expected inflation. Generally, for the expected inflation rate, this P is used because inflation rate is calculated based on what? Based on price index. Based on price index. So that's why this is the normal formula. In order to convert nominal rate to real or real rate to nominal, because using this Fisher formula, 1 plus nominal rate equal 1 plus real rate into 1 plus expected inflation. So when you rearrange that in terms of the real rate, right, so you get this formula. So this is the formula to calculate the real rate, because here simply this formula is rearranged. So real rate equal 1 plus nominal rate divided by 1 plus expected inflation, then minus 1. So that is the real rate. Because especially when we are doing finance, right, financial management, we should be very, very good in financial mathematics, right? Because that is essential for analyzing all finance decisions, right? So we should be very familiar with this financial mathematics, right? So these key principles, we should be very we have to have a good understanding about these key principles, because based on the information given relating to a particular organization, when we are evaluating a project, so these principles should be followed. When you have the correct understanding about these principles, you can do proper analysis, because the calculations are easy, but it's necessary to have the proper understanding about these principles, and the results should be interpreted according to that. And okay, this sensitivity analysis, right? Sensitivity analysis, that is a technique used to analyze the risk of a project. So here, to save time, I have prepared the relevant cash flows for this particular project, because when we have to evaluate a project like this, right? So here the details of a particular project is given. What is the estimated unit sales price, variable cost price, sorry, fixed cost. And when these details given, we can calculate, because generally this sensitivity analysis and scenario analysis we can't do manually, right? We can't do means it's a very difficult exercise, right? Sensitivity analysis, as some of you have mentioned here. Uh, okay, here uh, there is another question. When question specifically mentioned that the cash flows are real, cash flows are those cash flows, uh, real cash flows, and those cash flow are already adjusted for inflation. Then we do not need to do any adjustment to cost of capital. Uh, no, actually, if it is given, that depends on the information, right? So if the discount rate, if the cost of capital is indicated as nominal, if the discount rate is nominal required rate of return is given, but as so you have mentioned here, if it is given the cash flows are real cash flows, then the discount rate should be adjusted, because it should be consistent. If the cash flows are nominal, discount rate should be nominal. If the cash flows are real, discount rate should be real, right? Because it should be adjusted. It should be adjusted. And sometimes, if it is given, these the cash flows are real and the real cost of capital is given, okay, then no need to do adjustment, right? Here we have to use it consistently. We have to use it consistently, right? Because the cash flows and the discount rate should be consistent. That's why inflation should be treated consistently. We have to identify the basis of estimating the cash flows, right? We have to see whether the cash flows have been estimated in nominal terms, real terms, which means with inflation or without inflation. This discount rate should be used in line with that, right? If the information is given, the cash flows are in nominal terms, but the real required rate of return is this, then if the real required rate of return given with nominal cash flows, the discount rate should be converted to nominal rate. Okay, should be consistent. But if the information given, both information in nominal terms or real terms, okay, then it is not necessary to. Uh, uh, okay, here one question is there. Can we use some example of converting interest rate? Well, can be done. Only thing, this time is the factor. Uh, I will use one example which I have done to save time. Right. So here, maybe financial mathematics question right now here. Now, in this case, so these are the nominal cash flows, right? That now for here this question is relating to some maybe university payment and university fees change with inflation, right? Maybe applicable for a project, right? Project and so if this is the cash flow without adjusting inflation, same cash flows, it is real. But if we include the inflation and estimate the cash flow, nominal. And if the nominal rate is given, nominal cash flows can be used with nominal rate and we can calculate the present value. Here we get present value this amount, right? But we have another method. We can use real cash flow. And if we use real cash flow, what should be the discount rate? Discount rate should be real. But 8% means the nominal rate. And in this example, the inflation is 5%. And that is the formula, right, which I showed earlier, right? The formula I showed earlier, that is the formula to convert right, nominal rate to real. So this is the formula. Okay, 1 plus nominal rate divided by 1 plus expected inflation minus 1. We get the real rate, right? We get the real rate. So here 1 plus nominal rate divided by 1 plus expected inflation minus 1. We get the real rate. And when we get the real rate, and this is the rate we should use to discount these cash flows. Cash flows without inflation. Discount rate also should be without inflation. So here I have calculated using Excel or the financial calculator, right? We get exactly the same answer. Exactly same answer, right? So therefore, here actually I can use some detailed answer example, but it will take some time. Uh, uh, this is not a difficult part, right? So the converting nominal to real or real to nominal, that can be done using this simple Fisher formula. Only this Fisher formula is required, and using that, it's possible, right? It's possible to do this. Even for a project appraisal, I had one. Right. It's not a difficult part, right? It's not difficult. So it's converting nominal to real or real to nominal. So we have to use this simple Fisher formula. Simple rearrangement, no complicated mathematics. Cross multiplication. Haras gunide. Isko लिखे रहते हैं. Right? So that simple formula we have to use. We can use this Fisher formula, and when you rearrange that in terms of the real rate, so we get this real interest rate formula. And when you do that, you can use the nominal cash flows with nominal rate or the real cash flows with real rate. We get exactly the same answer, right? Exactly the same answer we get. Okay, so that is one important principle that we should use in the evaluation of a project, right? Because this part is fairly broad, and if we try to discuss with all the examples, that will take a lot of time. After we follow this, right? And in order to do the sensitivity analysis, right? In order to what would be, okay, there is a question, what would be the indicators to identify whether the cash flows are nominal or real at the examination? Uh, in the exam question, or this detailed information given related to company, from the information we need to identify whether it is given, so this the cash flows, this is the average inflation for the period, and the cash flows have been adjusted to this inflation and change with the inflation, and if it is given, right? Otherwise, if this adjustment is not there, right? As someone mentioned earlier, there may not be any specific information relating to inflation. But if it is not, if there is, if there are some information, okay, the cash flows have been estimated in nominal terms or with inflation, but this is the real rate, and if it is given that way, okay, then it is necessary to make this adjustment. It's not. I mean, it's should be identified based on the information given in the uh, uh, question, right? Because the only thing is nominal and real. These two simple concepts, right, indicate, because I can see you know the basis, right, from the answers given earlier, right? Based on the number of answers given very clearly, you know the difference between this nominal and real, right? Nominal and real, those two concepts applicable to many concepts, and even GDP. Because if you see the annual report of the central bank, you can see GDP. GDP at current prices, constant prices. Because we should know what are the different ways these two concepts can be explained. Current prices and constant prices. Current prices means it's nominal or real. Current prices means nominal or real. nominal, right? Because that's the meaning of nominal. Because nominal means, right? Nominal GDP means the value of the production at current prices, current year production at current prices. But real means what? Constant prices. Because if inflation is not adjusted, means what? Right? We do the estimate assuming the price level remain constant. Constant prices means real, right? So therefore, that's why in number of subjects we learn, because you have completed all the modules, right? It's quite difficult exercise. You have completed now the final maybe hurdle, which you can definitely do it very well. So you should be familiar with these key terms. What are the different ways this information can be given? Sometimes without directly given, these are nominal values or real values. Some other terms, right? This is the price of the product in the first year, which is change with inflation, right? At this rate for the next few years. It may be given like that, and the variable cost is this, which will change like this. So we have to identify, uh, uh, right? Okay, this valuation part also will discuss, and so therefore, based on the information, we have to identify, uh, right? So there can be different ways the information can be given at current prices, constant prices, nominal and real, with inflation, without inflation. So we should identify this key uh, information, right? Right. Okay. So this sensitivity analysis, I will use this example which I have already use this information here and do the basic calculation to save time. Now here, when we are going to do the sensitivity analysis, as I mentioned, manually it's not possible, because now when we do this basic calculation, when you do the basic calculation at this the given price, given quantity, and we calculate the net present value, right? When you calculate the net present value, right now here, this is the net present NPV and IRR according to the basic calculation. Now, sensitivity analysis means, because here now for this project there are several key variables: unit sales, price, variable cost, fixed cost, and okay, salvage value. So there are different key inputs that have been used to evaluate this project, to calculate these values. Now, sensitivity analysis means we want to check if the value of a particular variable change, what will be the impact to originally calculated value. When we do this, as I mentioned, it's not practical to do this manually. So we need to use simple Excel sheet, and then it will take only a few seconds to do this analysis. Now I have prepared this, given the proper link, right? Because when we do the initial insert the initial information, then all the values have been linked and the discount rate is calculated using the discount factor and the present value in PV, everything linked, right? Simple Excel sheet. Now, to see the sensitivity of a particular variable, it does not take time. But if we do this manually, now for example, if you want to check if the unit sales change means if the unit sales decrease by certain percentage, you can use any percentage, right? If the unit sales decrease by 20%, what will happen to the originally calculated NPV? To identify this, because we know if we do this manually, unit sales change means what? Unit sales change means variable cost will change. Revenue will change, variable cost will change, profit before tax change, after tax change, everything will change. We can't do this manually. So what we need to do, we need to use simple Excel sheet, right? And unit sales decrease by 20%. We have to change only one cell. Unit sales decrease by 20% means what we need to do? This should be multiplied by 0.8, 80%. And everything will be adjusted. If the unit sales decrease by 20%, what will happen? Now this will be the net present value. The net present value will be here. So I have already included the results of this sensitivity analysis here, right? So, and this is how we get the answers. NPV will change to minus 458. IRR will change to 14.7%, right? Then we have to check If the unit sales increase by 20%, again, we have to change only one cell. We need to multiply by 1.2. What will happen? NPV will be 24,200. IRR will be 32.2%. Right? That's what we need to do. We have to identify what is the sensitivity of a particular variable. Then if the price decrease by 20%, if the selling price decrease by 20%, same adjustment, right? So we need to multiply by 80%. This is what will happen, right? This is what will happen. And in this way, we have to see the sensitivity of each key variable. Now I have put the results of this sensitivity analysis. Sensitivity analysis, one technique, one method we use to analyze the risk of a project, risk of the project, right? And when we are going to do this, when we do this sensitivity analysis, now this is the result. We can identify the sensitivity of each variable. According to the sensitivity analysis, we change only one variable at a time and we identify the impact, right? We identify the impact. And based on the results of this sensitivity analysis, what do you think? What is the most sensitive variable for this project? Now, for this project, the results of the sensitivity analysis summarized here. What is the most sensitive variable? What is the most sensitive variable for this project according to the results of this sensitivity analysis? Price. That's correct. That's correct. So unit, selling price, that is the most sensitive variable, right? Why? If the unit, selling price of the product decrease by 20%, what will happen? Positive 11,800 NPV will change to negative 8,600. That means, right, what is the meaning? We can see, right, we can see what is the most sensitive variable for this project. And then what we should do, because these are all estimated values, what we should do, we have to do further analysis to make sure that the selling price has been estimated correctly. Because if the actual price that we can sell this product is less than what we have initially estimated, then what will happen? We might select a project which is not acceptable at all, right? We may select the project considering it is acceptable. So it is the most sensitive variable. You can see the sensitivity of the price to this project. Price is the most sensitive variable for this project. So therefore, the estimation of the price should be accurate. Otherwise, the decision is wrong. So in this way, we need to do, right? What is the next sensitive variable? What is the next sensitive variable? After the price? Unit sales, right? Unit sales also important, right? Unit sales also very sensitive to this analysis, quantity, right? Because you can see the positive NPV has changed to negative, right? Negative value is not this much significant, but still it is significant. So unit sales also very sensitive. Therefore, the estimation of the unit sales also should be accurate. What is the least sensitive variable? What is the least sensitive variable? Fixed cost. Fixed cost. No. Variable cost. No. Here, actually, when we consider this fixed cost and variable cost, the there will be impact when the value increase. If the value increase, yeah, the correct answer now here it is given salvage value. The correct answer is salvage value. The least sensitive variable is salvage value, because variable cost and fixed cost, the company has a problem if the value increase. Here, that is very significant impact, right? 11,000 has changed to 3,000. 11,000 has changed to 10,000. But what is the impact when the salvage value decrease? 11,800 has changed only 11,008. Very small impact. So we can see the least sensitive variable is salvage value. So even if the estimation of the salvage value is not very accurate, that is not a problem. But the main problem is if the estimation of the price is wrong, the entire analysis is wrong. The decision will be wrong. The unit sales, that's also sensitive. So that is the importance of doing this sensitivity analysis. Sensitivity analysis, that is useful to identify the risk. right? So to analyze the risk of a project, sensitivity analysis is used, right? And using that, we can identify the most sensitive variable, and further study, further analysis should be done to make sure those values have been estimated correctly. So that's the purpose, right? And in addition to that, it's possible to do another analysis which is known as scenario analysis, right? Scenario analysis that indicate if the uh, entire scenario change, right? If the entire scenario change, now it is like uh, this, right? We entire scenario change. That means everything change favorably. Oh, and everything change unfavorably. Main issue if the condition change unfavorably, so which is called worst case. Now this is the base case, and these are the values that have been estimated initially, right? And these are the values. But if everything change unfavorably, so then what will happen? So in this analysis, all the key variables we need to change to identify the overall impact, right? Unit say worst case means unit says right, unit says decrease, price decrease, variable cost increase, fixed cost increase, salvage value decrease, everything change unfavorably, we can see the impact. Everything change favorably, you can see the impact, right? So therefore, this scenario analysis and sensitivity analysis, these are the techniques used to analyze the risk of a project. To identify the risk of a project, these techniques can be used. And using this, we can identify the impact, and the further study analysis should be done to make sure, uh, right, before accepting a project. Before accepting project, so these analysis should be done. Right. So this investment decision, right? That's a long it's a decision which should be taken with detailed evaluation, right? Many stages there, many stages. When we estimate the cash flows, there are a number of principles that should be followed, and then using these techniques we can evaluate. And when there is a capital rationing situation, it is necessary to rank, and after that, it is necessary to further identify the risk of the project, and we can use techniques like sensitivity analysis and scenario analysis, right? Then the next important uh, part, right, the next important part, financing, right? So best possible financing strategy should be used, and for this it is necessary to know about the valuation. And there were a number of question in the chat box relating to this valuation. Valuation, uh, yeah, okay, here I mentioned at the beginning here, like, there is a chat message, can you share the material at the end of the session? I already mentioned. So this the, uh, the Excel sheet which I use here, but I can even share the other material, but that the other materials mainly I have used for some other programs, which include some examples which included in some other textbook, so therefore might confuse you if I share everything, because here maybe materials like this, there are some worked examples. The questions are not here. That's the problem. But that's why the key points I have included in this sheet. This one, uh, these evaluation techniques, the basic calculation, and NPV profile, the key principles, sensitivity analysis, capital rationing techniques. These things I have included. This Excel sheet I will definitely share, and and even this PowerPoint presentation I will share. Uh, if anyone needs additional materials which I use here, you can just note the material, and so if you request, maybe I can share my uh, email is there. Otherwise, there are so many. Uh, right. So this capital structure decision. Why we call this financing decision as capital structure decision? the capital structure decision, because for financing the investment of a business, the company can use different sources, right? The company can use different sources. And broadly, we use equity and debt. And that's why the way of financing the investment of a company will decide the capital structure. And that's why this decision is also known as the capital structure decision, right? The capital structure decision, which indicate the way of financing the investment. What is the percentage of equity? What is the percentage of debt? Right, debt to equity, right? So in the ratio analysis, you use this leverage or the gearing ratios, which indicate the capital structure of the company, right? Capital structure, which shows the way of financing the project. And for this, right, the different sources of finance can be used, right? Different capital sources can be used to finance the investment: equity and debt, right? Under the equity, what are the main sources, right? Company can use, because this equity and debt, okay, I don't need to discuss basics in this for this forum, because everyone has a very good understanding about finance concepts. You all know the benefit of using equity capital for the organization, right? What are the main advantages of using equity, right? You all know the advantages of using equity, right? Uh, and okay, compared to the debt capital, because whatever the source used by the organization to finance the investment, there will be a cost. And that's why we need to know what is the cost of equity and what is the cost of debt, which will decide the overall cost of capital of the organization, right? The cost of equity and the cost of debt will decide overall cost of capital of the organization, right? The cost of equity, which is uh, uh, calculated, that's an important part for the valuation of a business also, because when you are going to calculate the value of a business, right? So there are different approaches, right? But we need to know about this equity valuation and debt valuation. And especially when you are going to value these financial instruments, right? Because the valuation of financial instrument and the calculation of cost of capital very much related, right? Because when you are going to do this, when you are going to estimate the cost of capital, so it is very important to know about the valuation concepts, valuation techniques, because you should know how to calculate the value of shares and value of equity and value of debt instrument. Out of these two instruments, two categories, equity and debt, the valuation of which instrument is easier, you know very well. The valuation of uh, right, which one is very easy? Debt is very easy. Yeah, that's correct, right? Valuation of debt, very easy. Okay. So there is one. Okay, how to use this in the exam as a percentage for sensitivity analysis? That's why I mentioned this manual calculation. That's not possible either. Uh, Either results of sensitivity analysis should be provided. Otherwise, there will be this theoretical interpretation relating to the sensitivity analysis. Otherwise, generally for exam question, uh, to perform sensitivity analysis, there will not be a question, because that is not practically possible, right? Maybe the impact of the sensitivity analysis can be given, so that should be interpreted. Results can be given so that it can be interpreted. Otherwise, that's why I mentioned, if one certain values change, the entire analysis change. the entire analysis change. So that's not possible to do this manually. Okay, if the accounting profit has given in the information, whether we need to assume that uh, if it has not deducted the interest cost when we calculate the free cash flow. uh, so if the accounting profit that means you mean for all the years, right? For all the years, if the accounting profit given, so we need to identify whether the interest cost used to use for the debt capital finance is included, already adjusted there, because it should not be deducted uh, when we calculate the net cash flow after tax for the evaluation of the project. So therefore, based on the information, because if there is any adjustment, there should be relevant information to do the adjustment, right? Because we have to follow the principle. In order to calculate the net cash flow after tax to evaluate the project, we should not deduct interest cost, right? Because it is we when we do the discounting, the interest cost is already included in the discount rate. So otherwise, it's not, that fundamentally incorrect, right? So therefore, it should not be deducted, right? So for the valuation of uh, for the valuation, okay, so you have correctly mentioned the valuation of debt is very much easier, because that's why the instruments are known as fixed income securities. But the equity valuation entirely based on estimates, right? So that's why that's the more difficult part, right? So when you are going to value business, right, and that is entirely based on estimates, and the information should be available to do the valuation, because when we are going to do that valuation, uh, we need to identify several key information, right? Several key information we have to identify about because the price of any financial instrument means, you know very well the meaning of the price. No? The price of any financial instrument means the present value of the future benefits. So that's why you mentioned earlier also the valuation of debt is very much easier, right? Why? The future benefits we know in advance, right? We know in advance. But in order to calculate the price of equity, these future benefits should be estimated. And even the discount rate for a debt instrument, that is fairly straightforward. For a debt instrument, for the required rate of return, based on this concept, which you also mentioned earlier, right, correctly, opportunity cost. So that's why generally, when we are going to calculate the price of a debt instrument, generally for the required rate of return, we use market interest rate, right? We can use market interest rate as the yield, right? The required rate of return, opportunity cost, right? But when we are going to calculate uh, price of equity, the estimation of the discount rate is not that straightforward. That's why generally to calculate the price of a share, right? We Even if we plan to invest in different companies, the same amount we are planning to invest in several companies for the same period. We are planning to invest the same amount for the same period, but the discount rate, right? Discount rate, can we use the same discount rate, or discount rate should be different? If we are going to calculate the price, value of different companies, we plan to invest the same amount for the same period in several companies. So can we use the same discount rate for these several companies? Can we use? No, that is not possible, right? We can't. We can't. And we have to estimate the discount rate, which indicate exactly, right? So different base, because it is based on the risk factors of the company. What is the, what is the very commonly used technique to estimate the discount rate when you are going to calculate the price of a share equity? To CAPM, exactly, right? CAPM. So using CAPM, because using the beta, right, relating to that particular company, right? So we can easily we can estimate the cost of equity using the capital asset pricing model, right? Because that indicate the systematic risk attached to that particular share and using the beta of that company, we can calculate the cost of equity, right? So that's why even the estimation of the discount rate, that is not very straightforward when you are going to calculate the price of a share, right? So we need to estimate all these values. And even especially when you are going to do the business valuation, right? Because if we do this valuation from the investor's point of view, the estimates we have to do may be relatively less, because maybe a particular investor planning to invest only for 1 period, 2 period, only we can use simple models. But especially for the organization point of view, and from a particular organization, when the company planning to acquire another company, right, then what will happen? It is not possible to use this 1 period, 2 period models. And that's why it is very important to estimate growth rate. And to estimate the growth rate, there are a number of different methods that can be used. And when we are going to do valuation, business valuation, so it is important to estimate this constant growth rate. Using the constant growth rate, it is possible, right? It's possible to estimate the share price. And using these valuation models, what is the price we estimate? We estimate which price? Because it's possible to argue, right? Someone can argue why, especially, it is necessary to calculate the price of a share, because market price is readily available. When the market prices are readily available, why it is necessary to calculate the price? You know, it's not necessary to use these valuation models. Using the valuation models, what is the price we estimate? Okay, one is there. Right, x due price, we need to look at the synergies. Okay, but there is one very basic and simple point: intrinsic value. And this is the correct answer. This is the right, this is the relevant point. Using these valuation models, we estimate which value? We estimate the intrinsic value. What is the other term? Fair value. We estimate the fair value, intrinsic value. Okay, this is the proper finance term, right? Of intrinsic value. Intrinsic value. That's correct, right? That's why it is necessary to calculate, right? So when you are going to do a valuation of business, if we simply use the the market price, that will not show the real value of the share, because market price depends on what? Market price depends on what? As the term implies, market price. Market price means market price decided by the market. Market means demand and supply. Market forces, right? The market forces. And the demand and supply for shares based on what? The demand and supply based on what? Right? Demand and supply, especially for this financial instrument, right? The shares or debt instrument, the demand and supply depends on what? Future potential, right? I mean, price will be decided by the demand and supply, and demand and supply depends on what? Demand and supply, right? I'm waiting for the uh, because number of correct points are there. Future potentials and dividend and market condition, right? In simple term, based on what? Based on information. Based on information, right? It may be, this information may be relating to, yeah, this return and market condition, information relating to the uh, you know other factors, right? But information. And always then these market prices will be close to the intrinsic value only if what happened? Only if the information available to everyone. Information, if the information available to all the parties, what do you call it? Market should be, information will be available to everyone only if the markets are, okay, you can say perfect, but at least we use the market should be efficient. That's the correct term. Efficient, right? And that's why especially in developing countries, right? Especially in developing countries, why, right? Because there is also one important point for this module, which is given in this module, right? Because we need to know about these financial markets, right? So the use of financial markets to meet these financial requirements of these various parties. Because when we consider the financial system of a particular economy, financial system of a economy, uh, we know to meet the financial requirements of the parties, right? The organization, these parties use two different channels. No? You call direct finance and indirect finance. Especially when we do this evaluation for a firm in developing country. Because, right? So if you have to analyze a company in a developing country, right? Out of these two main alternatives available to meet the financial requirement, which are known as direct finance and indirect finance, right? So the two alternatives available, direct finance and indirect finance. Direct finance means directly the organization meet their financial requirement by issuing securities, financial instrument, maybe equity, maybe debt, right? But indirect finance means they need to meet the requirements, right? The requirements of the participants of a financial system, they try to meet using financial intermediaries. When we consider uh, the people in a developing country to meet their financial requirement, especially we call channeling of funds, some basic concept, right? Uh, Out of these two alternatives, what is the alternative used by most of the participants? Direct finance or indirect finance? Indirect finance, which is correct, right? Indirect finance. So, especially in developing countries, indirect finance. That means financial intermediaries perform a more significant role compared with financial markets. Why is that? Right? Why is that? What are the reasons? Why do you think that indirect finance or direct finance is less commonly used? Less commonly used. One main reason, right? One main reason is what? No efficient market. Exactly. Exactly. Right. In addition to this, easy to get, right? But here we can see, right? I can see a couple of very correct answers. Efficient market is not efficient. Market is not efficient, right? Information are not readily available. Market is efficient means what? Market is efficient means, right? The market prices of securities should reflect all the information quickly and accurately. That's how it is defined, right? In simple terms, efficient market means what? Everyone should get the information quickly and accurately. Is that the condition in developing countries? No, right? We call there is information asymmetry. Information asymmetry. So there is information gap. And due to that, what will happen? Some people have more information than others. Generally, most of the people, right? Because a lot of we call this is called information asymmetry, right? So due to this information asymmetry, what will happen? Some parties, right? Asymmetry information, right? And due to this, what will happen? Many parties lose, right? Because some parties have the ability to make we call supernormal profits, abnormal profits, and that's why these financial markets, right? Not that these markets are not efficient, and that's why especially many parties not very much willing to use this alternative. And when we analyze financial markets, so it is necessary to know about these main concepts relating to this market efficiency, right? Market efficiency. And I'm sure you know the different levels of efficiency which you have learned, which we don't have time to discuss in detail. And that's why these valuation models are required. So due to this market, since the markets are not very efficient, the prices may not be fair. The market prices not always reflect the intrinsic value, as you correctly stated here, right? So valuation models are required to estimate the intrinsic value, true value, fair value of this financial instrument. And based on that only the decision can be made, right? So we can identify whether a particular share is undervalued or overvalued, and based on that the investment decision can be taken. And so it is important to know how to estimate the cost of these different sources in addition to the the calculation of the price, right? When you know how the calculation of price, that means valuation of these different instrument, then the calculation of the cost of capital is easy, right? Because it is just the reverse calculation, right? It is just the reverse calculation. Because when you know how to do the equity valuation using these different assumptions, right? Because here, uh, to calculate the the value of a share, this is one very commonly used method, discounted cash flow approach. But that is not the only method, right? What are the other methods that we can use to estimate the value of share? In addition to the discounted cash flow approach, discounted cash flow approach means here we mainly call it dividend discount model. In addition to the dividend discount model, okay, net assets value, price earning multiples can be used. Yeah, okay. Net assets based method, free cash flow method, asset based valuation, asset based valuation, uh, price earning ratio, price to book value. Okay, there are number of methods that we can use, right? In addition to that, because uh, uh, when this to identify whether it is fairly valued or overvalued, when the market prices are not readily available, so we can even use this comparable method, right? Comparable method, especially based on these the points you have mentioned, right? So this for the equity valuation, so different uh, uh, methods can be used, right? But here, especially for the calculation of cost of equity, different methods we can use, and you mentioned earlier also one commonly used method, we can use a CAPM, right? We can use CAPM to uh, estimate the cost of equity, and especially when we are going to calculate the overall cost of capital, right? When you are going to calculate the overall cost of capital, we should know how to calculate the cost of these different sources. How to calculate the cost of ordinary share, cost of preference share, cost of retained earnings, cost of bonds, debentures, loans, and finally, the weighted average cost of capital. Right? And to calculate the cost of ordinary share, we need to uh, have good understanding about the calculation of share price, and based on that, with simple rearrangement, so we can calculate the cost of existing ordinary shares or cost of new ordinary shares. Because generally when the organization is going to use these different sources to finance the project, the capital structure they have identified as optimal capital structure, or you can say optimal or optimum, right? Capital structure, uh, it is generally organization try to maintain this capital structure when they change their capital, right? That means when they increase capital, when they raise capital for the new investment, they always try to maintain this capital structure, which they have identified as optimum capital, which is not fixed for all the companies, right? So because you all already know, right? You know very well this debt to equity ratio. Is there a debt to equity ratio that can be recommended for all the organization as the best debt to equity ratio, right? Is it possible? That is not possible, right? That is not possible because this the capital structure that depends on the terms and uh, the terms and conditions that we have to comply when we obtain various types of capital. uh, okay, and so it is necessary to uh, you know know about these the different terms and conditions that should be complied when obtaining capital. Therefore, uh, it is not possible to say this is the best capital structure that applicable to all the organization, because we should know the advantages of using equity capital, the advantages of using debt capital, and uh, equity capital, there are a number of advantages. The cost of equity is not an obligation, right? Cost of equity, not obligation. And since there is no maturity and no need to repay capital, right? And the organization has the flexibility, right, to decide this the dividend that should be distributed. So these advantages there. But debt capital, the cost of debt is obligation, right? Cost of debt is an obligation, and the capital also must be repaid. And if you need to justify, right, because someone can ask, the cost of equity is not obligation, no need to repay equity capital, whereas the cost of debt is obligation and the capital must be repaid. Why company use debt capital? Why company use debt capital? It is possible to finance entirely using equity. Then there is no obligation. The management has the ability to decide why it is important. One thing, okay, one answer is given, one reason. Okay, another point is there. Maybe so when we consider this main point, right, someone has mentioned cheaper cost. That includes several important points, right? And number of answers given: tax saving, tax shield, and tax benefit, right? That is also included there in that answer, cheaper cost. And in addition to that, that answer include one more point. Why cost of debt is cheaper? One answer, right? Okay, it's already there, tax saving. In addition to that, in addition to that, what is the other thing? Why cost of debt is cheaper? In addition to the tax benefit, okay, low risk. That's correct. Risk is low. In other words, less. Okay, that's totally correct, right? That's correct. And due to the low risk, what happened? Low risk means what? Low risk means less volatility of returns. So due to the less volatility of returns, less risk, and when the risk is low, the investors require relatively low return. The required rate of return is low for the investors, means the cost of capital for the organization is low, and that's correct, right? And okay, another very important point is given: control will not be given to the loan providers, which is correct. And that the same point is given in another word, in another answer: ownership will not be diluted, which is correct. And those are the reasons to use debt capital, right? Those are uh, okay. And there is another question, which is a very good question. If debt is good, why we can't finance all requirement from debt? Good question. Good question, right? If debt is good, right? Okay, here we didn't say debt is good, right? But we, right, said debt is cheap. The cost of debt is cheap, right? That doesn't mean debt is good. The cost of debt is cheap. Cost of debt is cheaper. Cheaper means, for that also we have to use another term. Cost of debt is comparatively cheaper. It's better to, right? We need to use that term, because we can't simply say the cost of debt is cheap. We have to say cost of debt is comparatively cheap, right? Comparatively, when we compare to the equity capital, right? So due to the two reasons you already mentioned, right? That is, when we use debt capital, we get tax benefit, which is not available for the equity. And the other thing, less volatility of return of debt capital. But equity, the return is highly volatile. And due to that high risk, the investors require high return. So the cost of equity is high. And so those are the reason. Those are the reason that the cost of debt is comparatively cheaper. Even if, this is a very good point, right? Which is a very good point. If the debt is, let's say, instead of good, if I use the term, if the debt is comparatively cheaper, right? And why can't we finance all the requirement using debt? Okay, here correct points there, right? So high the gearing, high the financial risk of the business, exactly. And even though there will be positive impact to the weighted average cost of capital when the debt capital increase, when the percentage of the debt capital increase, there will be definitely positive impact to the weighted average cost of capital. But what happened? So as someone has clearly in mentioned here, so we use special term in finance. When the debt capital increase, what will happen? The cost, the cost of financial distress will increase, and that's what here. So you have mentioned correctly. High the gearing, high the financial risk of the business, because major part of the cost of capital will be what? Will be obligation. And that's why someone has correctly stated here, if we're making losses, we have to pay interest, right? Because no flexibility. Because whether the organization make profit or not, the interest must be paid. So interest must be paid because when the debt capital percentage increase, and that's why these terms are used. High, the cheering is very high, and due to that, what is the meaning? The organization has very high default risk. When the organization incur losses, but no option, the interest must be paid. The capital must be repaid, and then what will happen, right? So there is very high default risk. So that's what we call the cost of financial distress. Even though there will be positive impact to the weighted average cost of capital, right? There will be very high risk. The end, very high percentage of the cost of capital will be an obligation. And that's why you calculate ratios like interest coverage ratio, right? To see whether the company has the ability to settle its interest cost using the operating profit. So it's necessary to identify these things. So you should know how to estimate the cost of these different sources of capital, right? So which I have summarized here, right, which we will not be able to discuss in detail, but no need to discuss this in detail. I'm sure you all know, right, how to calculate the cost of ordinary share, cost of preference share, and retained earnings. If a particular organization is going to use certain part of the retained earnings to finance a project, retained earnings, you all know very well, the profit already earned by the organization and retained in the business. So if they are going to use retained earnings to finance a particular project, the organization need not to raise new capital. But if the organization is going to use retained earnings to finance the project, is it necessary to calculate the cost of retained earnings to evaluate the project, or we can just ignore that? Retained earnings already earned and retained, right? Yeah, I mean, is it necessary? Need to calculate. Yeah, need to calculate. Why? Why? Right. Because okay, it's a part of equity capital, right? But why it is necessary to calculate? Okay, the answer is here. Need to calculate since there is opportunity cost. That is the reason. That is the reason, right? Because even though there is no new cost of raising capital, there is opportunity cost of using that capital, right? So a lot of good answers given here, right? So a lot of answers there, correct answers. And in addition to that, there is one answer for that previous question. Someone asked, good answer is given. It's if it is it's an obligation, that is debt capital, right? At the end of the day, shareholders don't want to dispose the business and spend their money to settle debt, because yeah, when the debt capital percentage increase, ultimately there will be a net, net liability, net assets will be minus, and in the case of liquidation, and here, so they have given clearly, the shareholders will not receive anything. And okay, so here the opportunity cost. Uh, Yeah, because the answer is, even though there is no new cost of raising capital, there is opportunity cost, and due to that, it is necessary to calculate the cost of retained earnings. And even the method of calculating the cost of retained earnings, some of you have already mentioned, right? Because this is part of equity. So because the cost of retained earning means it is the cost of existing ordinary shares. So we can use the discounted cash flow approach, dividend discount model, and what else? We discussed earlier also to calculate because here we need to identify opportunity cost. Opportunity cost means what is the required rate of return to the shareholders. So to calculate the required rate of return to the shares, you already mentioned the model we can use. We can use CAPM, right? We can use CAPM. Okay, here one question is there. What is meaning of 1 minus F? That is okay, in this formula, right? That means if the organization is going to issue new shares, if the organization is going to issue new shares, because this is the formula to calculate the cost of existing equity. right, based on the current price. But if the organization is going to issue new shares, what will happen? There will be a issuing cost, right? Generally, the one term used here, flotation cost, because flotation cost to issue shares, there will be a cost, because, right, I saw even in the study guide, and these things are explained in detail, right? These stockbrokers, underwriting, advertising, prospectus, everything should be, provided. So therefore, there will be very high cost of uh, issuing shares. This should be adjusted. This should be adjusted. So this issuing cost here, I have used simple example. So to raise this number of shares, to raise ordinary share capital of this much, right? If the issuing cost, the flotation cost is this much, right? We can calculate the flotation cost as a percentage or as an amount, right? Then what we should use here is the net price, because this cost should be incurred after collecting this price, because they may be able to sell at the current market price, right? If the market price is the correct price, but still there will be a cost. So if the cost is calculated as a percentage, we can calculate the net price, because here P into 1 minus F means the net price when we adjust the flotation cost. Because here, to calculate the cost of new ordinary shares, the issuing cost should be adjusted, right? The issuing cost should be adjusted, right? So using this discount model, dividend discount model, we can calculate. In addition to that, using CAPM, you mentioned earlier also, we can estimate the cost of equity. Flotation cost, again, one question is there. What is the meaning of flotation cost? So flotation cost is uh, the term used for this issuing cost. To issue the share, what is the amount, that's one term used, but maybe different terms used in another book. Doesn't matter. What is the value we have to use here? Net price. That's the point, right? That's the point. To calculate the cost of new ordinary shares, we have to use net price. That means the price minus the issuing cost. So we have to use the net price to calculate the cost of new shares. Generally, uh, when organization is going to raise capital, there is an order. Organization prefer to use, and what do you call it? So in finance theory, it is called, right? We call it pecking node theory. Exactly, right? Pecking node. So then generally organization prefer to use what? Prefer to start with retained earnings, then debt capital, and right, issuing new ordinary shares, right? Issuing new ordinary shares will be the last option. And you have given number of reasons earlier also, because if the company is going to issue new shares, that will affect to the ownership structure. In addition to the high cost, right? Issuing cost is there, and generally cost of equity is higher. In addition to that, there will be issuing cost, and it's a long process of issuing shares. And in addition to that, ownership structure will be affected. So due to this, issuing new ordinary shares will be the last option. So we can calculate the cost of new ordinary shares, which will be high, right? So to calculate the cost of retained earnings, we can use this dividend discount model, or we can use CAPM approach, and very similar method. Because this CAPM approach, this CAPM, this capital asset pricing model, that provide very logical basis for the investment, right? Any investment. That's why even though the capital asset pricing model was developed in 1960s, right? 1960s, but the basis has not been rejected, right? Because we know CAPM is a single factor model, but after that, there were many multi-factor asset pricing models, right? So you know that Farmer French 3-factor model, Farmer French 5-factor model, Carhart 4-factor model, arbitrage model, price model, right? But the basis used in CAPM has not been rejected. That's why all the subsequent multi-factor asset pricing models have been developed based on this foundation, which is based on modern portfolio theory. Introduced by, developed by, modern portfolio theory? You all know about, right? Harry Markowitz, right? So Harry Markowitz, and based on that, so it has been developed, and based on this CAPM, there is another method which is more suitable to calculate the cost of retained earnings when organization is planning to use retained earning for a capital investment. When organization is planning to use retained earning for a capital investment, means long-term project, right? What is the minimum return required? Because generally, when we use CAPM for the risk-free rate, generally what is the rate we use as the basis for the risk-free rate in CAPM? In CAPM, what is the rate we use as the basis? Okay, I mean, here number of answers given. I don't know whether this is for the uh, previous question I asked about when organization planning to use return earning for a long-term project. Answer is T-bond rate. T-bond rate. But for CAPM, the risk-free rate, okay, answer is there, T-bill rate. So generally, we use treasury bill rate as the risk-free rate, as the basis for the risk-free rate in CAPM, right? Treasury bill rate. But when organization is planning to use retained earning for a long-term project, what is the more appropriate value to use as the risk-free rate? Treasury bond rate. So that's why some of you have already mentioned T-bond rate more appropriate. So therefore, when the organization planning to use retained earning for a capital investment, right? This method is used to estimate the cost. Bond yield plus risk premium, which is entirely based on this principle, CAPM, right? Because CAPM provide that basis too. Because when we are going to make an investment, minimum we need risk-free rate, and for the risk we take, we need additional return, right? We need additional return. And so these different methods can be used to estimate the cost of retained earning. Cost of debt, that is simply, you all mentioned earlier also, the calculation of the cost of debt. Cost means, right? In fact, here there is one question, what about country risk premium? Because when we call risk premium, that risk premium should incorporate everything. It's correct. It's correct. Now this what is the size of the investment and what is the industry, and especially when the investment is when the organization is planning to make investment in a country with high risk. So all these factors should be incorporated to this risk premium, right? So these different factors should be incorporated to this risk premium. Okay, right. So those using this cost of various sources, right? And the cost of debt you mentioned earlier also, that is based on yield to maturity, right? So we have to calculate yield to maturity, and right, it may be a bond, maybe a debenture. If it is a long-term debt instrument, we calculate yield to maturity, but it should be adjusted to tax. That's the benefit you mentioned earlier of using debt capital. Always the organization get the tax benefit. So therefore, always the cost of debt should be the after-tax cost, and based on that, we can calculate the weighted average cost of capital, right? So weighted average cost of capital is the appropriate discount rate when we are going to evaluate a project, which indicate the minimum required rate of return. So when the cost of capital decrease, the value of the business increase. So organization should identify the combination of capital that minimize the cost of capital, which will maximize the overall value of the business. But when in doing so, the risk should be taken into account. And that's why, and so especially for this module, when we analyze the risk, right? When we analyze the risk, one main risk that has been specified, right? Specified in this module, the exchange risk, right? And for that, since we don't have much time, right? So here, this material I will share with you, right? This one also I will share, which include some good information relating to the foreign exchange risk, because foreign exchange risk, that is a very, very important part, because you know that when we are analyzing risk, even in investment, right? So that's why you studied portfolio theory, because some risk can be diversified, some risk cannot be diversified, right? Even the risk that cannot be diversified. So is it necessary, which you call as the risk that cannot be diversified? What do you call it? You know very well. You call it, right? The risk that cannot be diversified, right? So we call systematic risk. That's right. Okay. Someone has mentioned unsystematic risk. Unsystematic risk can be diversified, right? So a lot of answers, correct answers, systematic risk, right? Systematic risk that cannot be diversified. So then, so it is necessary to take some, because foreign exchange risk, that's also considered as a systematic risk. So that's why it is so important for the business organization, right? When making this corporate finance decision, so it is one very important factor that the organization should consider, because due to this foreign exchange risk, right? Because, which can be analyzed in many ways, right? I mean, many types are there. So you may have learned the foreign exchange risk arise due to several factors. That's why we call transaction risk, translation risk, economic risk, right? So which can be analyzed in different way, right? Transaction risk, economic or the operating exposure, then translation or the accounting risk, right? So various factors, because due to the change in the exchange rate, uh, there can be a loss from the transaction that organization has already entered. So there may be a loss the transaction organization planning to enter in the future, or uh, due to the depreciation of currency when we value, when we translate the assets and liabilities, that can be lost. And to minimize this, there are various strategies, some internal hedging strategies, right? And right, internal hedging strategies, matching cash flows, leading, lagging, that means managing the timing of the cash flows, multilateral netting when the organization has when there is a group of companies, so it can be used, currency diversification, pricing decisions, right? Currency clauses to share the risk. Various strategies, internal hedging strategies can be used. In addition to that, this also include one, right? Another point. It is possible to use some external strategy, hedging strategies like derivatives, right? So derivatives, that's also possible to use, right? Some derivatives, external hedging strategies. You think you have learned about derivatives instruments, right? So derivative instrument, what are the various types of derivative instruments? uh, Okay, so here one question is that can you briefly explain how swaps can be used by an organization to minimize foreign exchange risk? Okay, that's good. Here I have included some basic points related to derivatives also in this Excel sheet, because one main thing. So here you have included one very important concept, which is especially important for the managing of foreign exchange risk, which is correct, right? So swaps mainly can be used because there are two main types of swap contracts: interest rate swap, currency swap. Especially, right, to address the point you have included here, right? Uh, so how to use these swap contracts to minimize foreign exchange risk? That depends on that depends on uh, when we consider the depreciation of local currency. Now, when we consider the depreciation of Sri Lankan rupee against various other currencies, when you analyze the historical pattern, Sri Lankan rupee. So, what is the currency that shows the highest depreciation? Against which currency? Against which currency Sri Lankan rupee has shown the highest depreciation? What do you think? Okay, a lot of answers US dollar. No, no, that is not the currency that shows the highest depreciation. Yeah, this is the answer. Yen, right? Yen. So yen. If you see the yen rate, maybe 20 years, 30 years back, what is the yen rate? Maybe 1 cent or 2 cents we have paid to, right? Only 1 cent in Sri Lankan currency they have paid only, because you can see this when you refer this central bank uh, website. So in the central bank website, if you see the annual report, right, annual report of the central bank, there is a special section called special statistical appendix, uh, right, special statistical appendix, which include the information for the last from the incorporation of the central bank, right, from the incorporation of the central bank. uh, there is a special section, special statistical appendix from the incorporation of the central bank from 1950. The information there, a lot of good, right, important macroeconomic information from the incorporation of the central bank in 1950. Population, GDP, right, national output, prices, balance of payment. Okay, here, and these are the exchange rates. Here, these are the exchange rates, and uh, right. So if you see the yen rate, even in 1980, right, or 19 here, what is the amount we have paid? Only 2 cents to buy 1 yen. We have paid only 2 cents, right? And when you calculate the depreciation as a percentage, right now, right, so recently these are the values we have paid. If you calculate as a percentage, that is the highest rate. And so I was attached to the public debt department of the central bank some time back, and some of the loans we have analyzed, if we receive say 500 million yen, but in terms of rupees, that's a small amount, because you can see the exchange rate you have to use, right? The amount in terms of rupees, right, when you calculate, and when you see with the depreciation of rupee against yen like this, and when we see the repayment, we have paid more than 10-15 times of the loan that we have taken in terms of rupee. And the worst thing, still we have to pay about 10-15 times of the amounts we have received. But dollars, yeah, rupee depreciated, but not as yen. So that's why now that's the point relating to this answer. So the question some of you have asked, it's true, and sometimes there was an arrangement to repay yen loan using US dollars, right? So in terms of the calculation, these values in terms of dollars, and if you pay in terms of dollars, better, right? Because the depreciation of rupee is relatively low. Again, I'm using comparatively, right? Comparatively low, because rupee has depreciated against all the currencies, right? See the amount of rupees we have paid to buy these major currencies in 1950 and even in 1980, and see the amount that we pay now. But when you calculate the percentage, the highest depreciation, maybe you can see against yen. And if uh, as you correctly mentioned, if it is possible to use currency swap, right? So we receive the amounts in yen, we pay in dollars. So currency swap means that, which I have very briefly explained here, because these different types of option contracts, derivative contracts. Derivative mainly, I think you had a topic or module in the previous exams relating to derivatives. You had, right? You had, yes, right? So under financial management, so you have learned that. So derivatives you already know. So these are the agreements, these are the contracts with between two parties to do the transaction at some future date, the price agreed today. Main objective, hedging, right? So derivatives have been developed to achieve the objective of hedging. But even though hedging means minimizing risk, mitigating risk, even though derivatives develop to minimize risk, many parties use derivatives to take risk, which is known as speculation. Speculation, right? So because here, for any derivative instrument, there is an underlying asset, and especially when we use these derivative instruments for the risk management, the underlying asset is foreign currency, right? So different types of derivative instruments can be used. One thing, okay, you have learned derivatives, and so here, uh, so due to these time limitations, we'll not be able to discuss in detail. But for your benefit, these different types of derivative instruments, I think you already know. Uh, uh, right, so here main features of these different types of instruments I have included, right? Because these derivatives external hedging strategies, right? So without referring in detail to these different categories, which is not possible at this moment, but one common thing, so derivatives, when when we enter into derivative instrument contract, we know there is no uncertainty. Now especially if, with respect to this foreign exchange, right, which is the main derivative, main underlying asset used in our country. If we enter into derivative contract, if we use derivative instruments to manage the foreign exchange risk, we know there is no uncertainty. Now, for example, organization planning to buy certain maybe equipments from another country, and they know there is a certain foreign currency payment that should be paid, and for that amount they use forward contract or futures contract, option contract, right? Now there is no uncertainty. We know exactly what is the amount that should be paid. Does that mean there is no loss due to the derivative instrument? Is that the meaning? When the organization use derivatives, no uncertainty. No uncertainty, does that mean uh, there is no loss to the organization? Is that the meaning? No, right? That's correct. Because that's why organizations should not hedge all the risk. Because when we use derivative contracts, we can see we agree to buy or sell, right? Because especially with respect to this foreign exchange risk, organization need to use derivative contracts to hedge both foreign currency receipts and payments, right? Because if the organization receive a lot of foreign currency from the customers, foreign customers, they need to make sure they don't incur less loss due to the change in the exchange rates. So therefore, the organization has to both buy and sell foreign currency, right? Therefore, this situation should be used, can be managed, can be the risk can be minimized using derivatives, but derivatives should be used with proper evaluation, proper understanding, right? Uh, no, here, okay, one question is there. We manage the situation using derivatives. Neither party get loss or profit. Is that the condition? Is that the condition when we use derivatives? No, derivatives. When we use derivatives, always there is a gain to one party. There is a loss to another party, right? But right now, for example, I will use very simple example. Uh, as organization, I'm going to buy a particular equipment from another country, so I have entered into a derivative contract with a bank, forward contract. I want to buy $2 million in 2 months, entered into a contract to buy US dollars. I get the benefit from this contract only if the exchange rate increase or decrease, right? I have entered into a contract with the bank to buy dollars. Yes, I get the benefit from the contract if the exchange rate increase. It's perfectly correct, right? But if the exchange rate decrease, what will happen? I lose due to the contract. If the contract was not there, it's better. But right, if the exchange rate decrease, what will happen? So I have agreed to buy US dollar at a particular rate, but now rate decrease. Loss means what? It's not accounting loss, but there is a, you know, there is a there was a possibility to buy US dollars at a lower rate if the contract was not there, right? So that's why always there is a gain, there is a benefit from the derivative contract to one party and loss to the other party, and that's why derivatives are known as zero sum game. The gain to one party is equal to the loss to the other party, right? uh, okay, what will be the best derivative applicable for our case? Uh, uh, that actually it now yeah, especially we have some disadvantages. I mean, especially even when we are learning these derivatives, we have uh, uh, we have one I mean, as when we are studying, right? Because we have less experience in our country relating to these derivative instruments, because there is no active derivatives market in our country, right? So mainly these forward contracts are there, and even as someone has mentioned here, there are no active futures or other derivatives market in our country. So therefore only some derivative instruments can be used. So therefore the use of okay, yeah, some derivative contracts, it's possible to enter, right? It's possible to enter. And the important thing here, when we are using derivatives, it should be used with proper understanding, right? Because all the risk should not be hedged, right? So the organization should do the proper evaluation, detailed analysis, and based on that only, the risk should be hedged, right? So that's why the derivatives should be used with proper understanding. Otherwise, you know what happened to our country due to that oil hedging contract, right? So the people who entered to these contracts without proper understanding, you know who was the chairman of CPC that time, right? So what is the qualification he had? Person who has not even passed O-level exam, uh, was performing as the chairman of CPC, right? And in addition to that, a lot of political influence. And so we know what happened. The country lost about $800 million. So due to the hedging contract. So that's why these derivatives should be used with proper understanding, right? Asanta the mail. Yeah, that's correct, right? Uh, so here, derivatives contracts should be used with proper understanding. Be used with the proper evaluation and should be used depends on the expectation. Yeah, yeah, yeah. One CA was attached. That's true, right? So very sorry to say that. And so that's what happened when in any profession, when politics involved, they make damage to the profession. Also, I mentioned the name also, but I didn't mention here, right? Better one, even who was a president of the Institute of Chartered Accountants once, right? Okay. Uh, so then uh, that's why sometimes when some people involved in politics, they make damage not only to their name and also to the profession, right? So but uh, so here actually, generally when I do 3 hours session, I give short break in the middle, but yeah, I continuously uh, talk for more than 3 hours, right? And then generally these online classes, I prefer when so the participants talk, but here I realize that it is not allowed to talk. But it's very good that you right, you all very actively participated. I'm quite happy. And so like that's why I always uh, prefer to do session for my profession as a chartered accountant. I always willing to participate for these sessions with the chartered. As I mentioned. So in few days, all chartered accountants, we meet uh, in the I'm sure in the next national conference, uh, right? So I haven't seen any of you, but maybe when you see me, I use specs only to read, and so maybe you better uh, right. So it's good if you can talk, right? And so but here, so the area that I had to cover is fairly broad. Corporate finance means one broad area in chartered accountancy exams, right? And so very active participation. I'm very happy, and I wish you all the best for your right? Uh, uh, Future, the final hurdle. I'm sure you all will get through very well. So I wish you all the best in everything you do, and uh, then so we might meet one day, right? So definitely in the national conference, we'll meet. So maybe say hi and say a couple of words. It's good, right? So then wish you all the best. So if anything, my uh, email address is there. So if you uh, need any help relating to these finance uh, modules, right? Okay, uh, you can right. I will share these materials with Mr. Aruna, right? So he will share with you, right? So if you require any addition, I use some materials from some other which I use in some other lectures, right? So let's meet one day, right? So the national conference will definitely meet. So wish you all the best. Thank you so much for the active participation.